All right, let's get into it. We got a macro report, the jobs report here on Friday, and very surprising. Very surprising. First, we're going to start with the unemployment rate here. If you're here on YouTube, if you're on TikTok, check it out on YouTube. We have the visuals. All right, so let's go over this report. So we do have here the unemployment rate dropped to 3.6. So what does that tell you? That tells you that this economy, as we've been saying, a rolling expansion is starting to play out. We got a rolling expansion and a recession at the same time. But I think we're starting to leave the recession, and we're seeing the bond market react to that. Overall, the unemployment rate is falling. It's still at record, historic lows, and we don't really see that changing anytime soon, right? Because we have a lot of fiscal policy on deck now. So we know unemployment rate lower than expected. Now let's go to, oops, why is that not pulling up? That's weird. Either way, yeah, we got a low unemployment rate now. Non-farm payrolls. This was, we got private payrolls yesterday, and those smashed expectations. But today, unfortunately, well, actually, it doesn't really matter. But surprisingly, I'd say more surprisingly, we got the, let me zoom in on this. We got the non-farm payrolls, which is really the payrolls report that we want to focus on. Beneath expectations, it was expected to come out at 225 to 250 thousand jobs, right? We came in at 209. So we're still positive. And remember, at this point, economists were expecting this year that we'd be negative in payroll. So we're still positive, but we didn't beat, right? We did not beat expectations. So that kind of falls back in line to where we were before, which is, the economy is still expanding, but at a slower pace. So we got positive payrolls beneath expectations, though. So that kind of calms the Fed a little bit. No surprises there. Unemployment, I don't think the Fed cares. Unemployment at a low rate, that's exactly their mandate, to keep unemployment, low. All right. Now, next, average hourly earnings. Let's go to the year over year. Average hourly earnings year over year. This is for the 3 months in a row, we've been at 4.4%. And what this signals is, if you're here on YouTube, you should be able to see this. What this signals is, okay, get that out of my way. Don't care. What this signals here on the unemployment rate is, the average hourly earnings is wages, right? Wages. So you want strong wages. You definitely want strong wages for an economy, for consumers or for employees. You want the strong wages, but 4.4% is still a little bit too high. Why? Because it also signals wage inflation, right? You don't want wage inflation coming in. So we're sticking at 4.4%. That's not negative. It's not bad. But I think we want to get beneath 4% to really be safe, where the Fed can fully reverse. I don't think we can start QE until we get beneath that 4.4%. Either way, we're not taking higher. Okay, we are not taking higher. We are flattening out. But that's one little tick to the downside, because wage inflation is also an issue. It's good for you, but it might be bad for the Fed's expectations. Definitely for the Fed's expectations. I still don't think it's that crazy. Labor participation, let's go into that. Labor participation, sticky, very sticky at 62.6%. That's good. That's good news there, because it basically tells you that the labor force is like the economy is rolling. We're getting jobs. We're getting people coming to the workforce, and they're sticking there. They're not leaving, right? And there's a couple of reasons that might be. A lot of job creation here over in Phoenix, where I'm at, Phoenix, Arizona. There's a lot of manufacturing being built here. The Taiwan Semiconductor, or TSM, facilities are being built constantly. There's a lot of apartment buildings being built. People have jobs. So people are coming to the labor force. That's good for the economy. May not be good for rates in the short term for the bond yields, but for the most part, that labor participation rate is a signal that you don't have to raise your wages, that companies do not have to raise their wages to attract more workers. All right. Average hourly, we don't need to worry about that. Manufacturing payrolls, government payrolls. Yeah. So overall, before we hit the market overall, and we're going to go see what the macro forces are doing. So we'll take a look at that. And I'll zoom in on here. And this also is a very global net liquidity is on the decline. So we're going to talk about that before we get in the market, though. So let's take a look at these macro forces. I'm going to zoom in on this. Again, jump in on jumping on YouTube if you want to see the visuals, if you are on TikTok, what up, David? Come check us out on YouTube. All right. So good morning, Ace, Manny, good morning, Dimaj, good morning. How you guys doing this morning? Market's looking, the market is recovering. We're gonna get there. We're about 35 minutes into the market. Remember, always keep in mind the market must digest the news. It's not going to, the first initial moves aren't necessarily what's going to be happening, right? The first initial new moves are like, how do we digest this report? We got a payrolls report beneath expectations, but still positive, right? We get unemployment lower. That's always positive. If it goes higher significantly, it forces the Fed, or at least puts pressure on the Fed, to end their hiking cycle. Even though they're on pause now, they haven't signaled yet that they're going to fully end their hiking cycle, right? So we're going to check out also, is the market pricing in another chance of a hike? I think it's already at 96%. We'll check on that. Either way, let's take a look at these macro forces. All right, let's zoom in here. And let me get us to this side. We're still in the macro report. So dollar, this is, okay, first let's go to bond yields, right? Because this is the story right now. We talked about this yesterday. KRE, the regional banking ETF, is at risk of rolling over. And that's a signal because these treasury bonds are selling off. So when we take a look here at bond yields, this is the cost of capital. The cost of capital is lifting, right? Is still lifting. And I think I think we'll see this until the inflation report comes out. My guess is that what we're seeing here is that, just if you guys are just joining in, let's go to TLT. This is actually the bond market. You can see the bond market is starting to fall apart, right? Let's take that volume off so you can see this. The bond market is selling off. This is basically the collateral, the government's collateral, US bonds. It's already down, 60%. What are we down? How much are we down from the highs, right? We're already down, okay, 40%. This is the biggest bond sell-off in history. US Treasuries, ETF, TLT, just a proxy for the US Treasuries. These are on the long side, by the way. Now we're either at support or we're going to crash lower. So this is an issue for collateral, for the government's collateral. And so when the bonds sell off, when we see the bond market sell off, or the US Treasuries collateral, the US Treasury price or the value fall, it pushes yields, bond yields, or the cost of capital higher. And so we're seeing that, right? The 10-year yield is climbing. The 5-year yield is climbing. This is the 5-year borrowing rate, you could say. And the 2-year yield. But it looks like the 2-year might have peaked out because those payrolls came in lower than expected. So that's kind of good news. I think, again, like we said yesterday, the market finds a bottom here. I think we do find a bottom. We just need to digest the news. The unemployment rate low is not negative. The bond yields are not going to spike because unemployment is low, because more employment, more workers equals better productivity, taking care of that supply side inflation, right? The more people the more people that work, in theory, the more production, the more supply, the lower your prices, right? You don't get that supply side inflation. And yeah, your demand goes online, but people are spending in the services sector. So we're getting growth there. Growth is not falling off a cliff. So yeah, now the downside would be usually when yields climb like this, we start to see the dollar climb, but we are not seeing this. So this is a bullish signal for me, which is that yields are still climbing, rates are climbing, right? The bond yield, the treasury market yields are climbing, and which is kind of the interest rates to the market, but the dollar is not. The dollar actually sold off. So that is risk on to me. I see that as a risk on signal. We're seeing now it's not completely risk on, just the initial move, the initial reaction is that, this is not negative. That's the initial reaction. If the dollar spikes, then you're getting an initial risk off signal because, people are like, okay, you know what? This is uncertainty. Let's get out of here. Let's get out of these assets. Let's get into the dollar, the reserve safe haven currency. But that is not happening. So yeah, 10-year yields are climbing a little bit, whatever, who cares? Let's go to oil. This is the most important chart, I think, still to date. Oil is starting to climb. It has resistance at 74.75, right? If we get above that level, then expect in inflation. Then if oil really gets above this level, that means that inflation for August, right? June, July, August, which will be this print, might be a bounce. I think we still collapse in CPI. I think we go to the low 3s, possible 2s in this next print. But if oil keeps climbing and gets above 75, then the following month will be will show a little stickier inflation. So that is a concern, but we could come up to this level and just sell off. We'll see how that actually plays out. A lot of people think, hey, demand is coming into the market, but we see manufacturing is still slowing. And also, a lot of production happening. So we're going to keep our eye on oil. Now, move on to the VIX, right? This is the VIX volatility, the volatility of the VIX still declining, right? This is the volatility of the VIX. So this is insurance against the equity market per se, the S&P 500, and it's still trending lower. All right, we had that big spike yesterday. This is more risk on. We had the big spike yesterday. Nothing happened. We spiked into the trend and we're coming right back down. The report's already over with. It's coming back down. A lot of positivity in that report. And so that's a risk on signal. I think we're just going to find a bottom today. Maybe we'll check out the equity market in a second. But let's see, me throw the SPY down there in this other window so I can see. I know somebody requested, what did your setup look like? I'll show you if you're on TikTok. I'll pull up and show you in a second. Yeah, S&P's finding support. Like looks like we're lifting above yesterday's line. Yeah, that's pretty bullish in the short term. Okay, so S&P is still holding up. Okay, here's the risk that I am seeing though come into the market. Bond volatility just spiked. This you do not want. You do not want bond volatility spiking. And pay attention to this. This is why. And this is the move index. This is volatility, the VIX for the bond market. Why? Because the more volatile and this is spiking because US treasuries are falling off a cliff in a second. They're not really falling off a cliff right now, but the US treasury market is a little uncertain. So if this volatility rises, what it signals is, it signals for lenders who use US treasuries as a benchmark for lending. Oh my gosh, the collateral is at risk of falling apart. So we're going to have to increase our lending rate to borrowers. That's what the higher the move index, the more the interest rate or the bigger the haircut or the bigger the interest for borrowers, which lowers demand, which, lending is how we grow our economy. This is not a cash society. This is a debt society. This is a debt world we live in. So if bond volatility is up, if the volatility of debt is going up, then that means lenders are going to increase their their rate on that lending, and that's going to crush growth. So we want that lower. So that's not the best thing. So that is a risk. But if we go to triple B spread, still falling, still bullish on that. This is debt volatility. I'm sorry, this is equity debt. This is US Treasury debt versus the government's debt, okay, against the corporate debt, right? So the equity debt. And as it falls, that tells you that there's still risk being taken in the corporate debt market. So that's good. That's a good signal. So yeah, there's a lot of different signals. You got to digest all of them and say, hey, okay, where are we headed? What does it look like? Bond volatility is climbing, but Janet Yellen just met with China, and she already talked about last year. She talked about last year buying back US Treasury. So I think that's going to lower bond volatility when that commentary starts to hit the tape again sometime this summer. Right. And so we went through that. What is crypto looking like? Well, first, gold. I know a lot of people like gold. Let's take a look at gold. Gold's doing nothing. I don't expect gold to really move until they ease quantitatively. But hey, you want to be in gold when they start debasing the currency, or you want to be in Bitcoin? Bitcoin will outpace gold. Bitcoin's going to outpace gold. Bitcoin is going to outpace gold. A lot of people are bearish on Bitcoin. That ETF will come. Maybe it takes a while. Who knows? But Bitcoin is hanging in there at that very 31,000 to 32,000 level. Once we get above this level, it's it's lights out. It's lights out. A lot of FOMO will come back into that market. Ethereum still, struggling there. These are the two blue chips that we will look at. Oh, NASDAQ volatility. That is another one. NASDAQ volatility. We can take a look at that with VolQ, and it's pretty much still suppressed. Maybe it's gaining a little bit of ground to the upside. Nat gas still low. So energy inflation, don't expect it to go anywhere. Copper still selling off. Not till China really comes back online, we won't see copper, start to rise again. And that is a proxy for commodity inflation or commodity prices in general. All right. So as long as oil and copper, two of the biggest commodities on earth, stay below trend or, continue to downtrend, then you're not going to get no real inflation. And as productivity, as workers come back online, as the unemployment rate drops or remains low, then you get more supply side and inflation is non-existent. So we're expecting inflation to collapse pretty soon here. Maybe it doesn't, but that's the trajectory. That's the outlook for me right now. Yeah, so that's it. That's what we're looking at. Let's take a look really quick on the big term charts for the S&P 500 equal weight. It's trending higher, right? All these arguments that, hey, there is no market breadth. Well, you know what? You're not going to get market breadth until uncertainties really start to leave the market. But if we're in such uncertain times and you're seeing the equal weight still trend higher, making higher lows, then that's a good sign, right? That tells you that there is a lot of stocks that are still grinding up, still grinding higher. This is futures, SPX pullback. All right, now we can jump into the actual charts. If you have any questions, let me know. Throw up the questions. If you have any comments, any charts you want me to look over, I'm gonna switch over. I'm gonna switch over to the charts to see what we're looking like on Tesla, on big mega cap tech, and then we can also take a look at some other stuff. But yeah, that's what we're gonna do here. Let's see, SPY, S&P 500. Supporting that level. I'm going to actually come down to the 30-minute chart here. So let's take a look at this chart. What do we got? Yeah, so here's the chart we got. Right, this was the sell-off from the ADP's payrolls yesterday. We had that huge gap down. We tried to fill the gap, but we didn't fill the gap. But today we are struggling at this level, right? There's no clarity yet. Maybe something hit the market. Maybe some. Let me see if there's any news that are hitting while we're talking. A lot of stuff coming in the pipeline. Nothing too uncertain, right? But either way, this is S&P 500 chart that we're looking at. And we just got to stay above this level. This was the previous gap up. And we got below that yesterday, but we found support. We got back above it. Now we're starting to support again. And we just got to stay grinding sideways, right? We're going to consolidate for a while to see if there's anything else coming into the market that's negative. So that's S&P. Still has some room to the upside. And the Qs look exactly the same. If anything, the Qs are a lot stronger than the S&P. On a technical basis, right? The Qs are still looking strong, still consolidating sideways. And if you really take a peek in here, what we are seeing is an ascending wedge, right? You could call this an ascending wedge, which is a pattern that is setting up, a bullish pattern setting up into the zone. So we'll see if that plays itself out. We just got to climb this trend back to the gap fill, and then I don't see any crazy risks in the market. We talked about it yesterday. The biggest one is KRE, right? The regional banks, and yeah, the KRE is a risk, right? KRE, the regional banking ETF is a risk because if it keeps rolling over, and we do have, let's look at KRE really quick. KRE is the regional bank ETF, and if it does roll over, and I do see a head and shoulders pattern here, and we break this trend. Here we go. There's the shoulder. There's your head. There's your shoulder. Okay, it did bounce off the trend, but over the weekend, you never know what could happen. As these treasuries sell off, their collateral goes lower, and as their collateral goes lower, they become at risk for insolvency or illiquidity. So, either one, there's always something in the pipeline. So if this breaks down, the bond volatility will probably spike, and it'll be a little sketchy at first, but I expect the BTFP, the Bank Term Funding Program, or buy the F and dip, some people call it, or BTFT. What is the other word for it? Buy the Fed pivot to step in at some point, right? A lot of names for that. So KRE banking, basically regional banks, can they hold on? Are they going to fall apart as the U.S. Treasuries sell off, or are we going to get the U.S. Treasury step in and start buying bonds to stabilize the bond market, right? That is a risk, but we know it's there, so it's not a surprise. All right, taking a look at the Dow. The Dow looks exactly, the Dow looks normal. It looks exactly like it's doing the same. Yeah, Dow's kind of flat. We're undecided here. We might even trade sideways until earnings start to come out, till we get earnings back into the back into the picture to find out what's going to happen with earnings. IWM. Now these are the small caps, right? A lot of risk taking. The small caps are moving back up. Okay, that's a strong move. Small caps look to be stronger than everything else. Let me look at my other chart. Looks like IWM this morning is definitely the strongest index. You right? Why are we getting risk on for IWM? What's going on with Binance? Binance executives start to exit. Okay, here comes Coinbase. I wonder what Coinbase is looking like. It's probably reacting. Now ARK is weakening, right? ARK is weakening. It's still up in the trend, but ARK kind of sold off on those high yields. Those high yield when rates go up, those U.S. Treasury when the U.S. Treasury value or collateral falls, then rates go higher, and that hurts these riskier assets that are looking like 5, 10 years into the future for earnings. So ARK did get a little hurt at first, but it looks like it's starting to pick up. Now there was a chart that I seen Benjamin Cohen. He's a crypto guy, and he put a chart out that showed global liquidity, falling off a cliff. And I just want to address that really quick. I want to address this global liquidity picture, right? And this is the chart for global liquidity. So you're taking you're taking the Fed, you're looking at the Fed or the Federal Reserve's liquidity, the Bank of Japan, the BOJ, you're looking at um, the PBOC, the Public Bank of China, the Bank of England, the European Central Bank, and the Fed. You're looking at all their balance sheets and you're saying, okay, what does it look like? What are we looking at here? And obviously you can see this divergence. You can see that global liquidity starting to roll over, right? Oh my gosh, it's going to fall off a cliff. It's going to roll over while the S&P is going up. That's a bearish divergence. But keep in mind here that this is not a stock to be traded, right? This is not a stock. This is just a cycle. Liquidity goes up and it goes down. Liquidity goes up and down. And it's really, I don't think it's going to keep going down. I see some other year on year liquidity pictures and they look pretty solid, right? A lot of the year on year liquidity indicators to me look solid. The second part is this doesn't take into consideration fiscal government liquidity. So it's missing fiscal liquidity here. If you saw this chart, and I'm going to keep using this chart. This is actually a really good chart because when it does start to turn up, that's going to be a lot of fuel for the fire, right? That is going to be a lot of fuel. But on the other hand, yeah. So if we're if the White House and who knows, I don't know the other fiscal stimulus coming out of China. I know China is stimulating, Japan is stimulating, but whatever fiscal stimulus that's coming out for them, we're not seeing that. And so if we did see that, this would be turning up. And I have a lot of other charts that are going to be in the macro newsletter that'll be released tomorrow morning that show that actually global liquidity on a year over year basis is still turning up, right? There's still global liquidity supports, especially if you talk about fiscal liquidity. So just want to address that really quick. And we'll obviously come back to that in the future. And if KRE, starts to roll over, we're going to get a lot more Fed liquidity either way. Okay, let's get on these pre-market levels. Palantir was a nice dip buy. You see the hammer candle on the daily. Yeah, Palantir moved pretty strong. Yeah, I see that dip. I see that hammer candle. It is forming a nice little descending wedge. I'd love to see it consolidate a little more. I really do like Palantir. That is a good, but either way, yeah, if you're looking into the future, good little dip buy. Yep, Palantir. Let's see how Palantir starts to perform. How's that RSI on the weekly? I want to see the weekly RSI. Has it came down enough? It's coming back onto the trend. Could make another big move if the S&P, if the the overall cycle starts to turn back up again and we start getting that wave 2 FOMO, which I think will come in. We got to wait for that inflation report though. The inflation report is going to give us the big signal. That will give us the big signal on that front. Okay, let's see. What do we got down here? Coin. I want to take a look at coin to see if it does. Coin is pressing, as you can see here. Coin. I don't know if a lot of people are a fan of Coinbase, but Coinbase seems to be in line to take market share as things start to turn up. BlackRock is using Coinbase, right, for their settlement, right? I believe so. I don't know the exact name, the technical term for that. But if Coinbase gets above like $100, right? Still has a ways to go, but if it gets above that, I mean, that's a reverse head and shoulder. That's a clear breakout pattern starting to form for Coinbase, which is just a sign of bottoming. Right, here we go, shoulder, head, and here we go, right? So once we start breaking above this, I'd even argue we're already in that breakout phase. It's a little early, but the RSI is pretty strong. The RSI is pointing higher. So Coinbase above this level is going to blow. You got MicroStrategy still pushing higher. Big short squeeze imminent on this for this name, 30% short float. So Coinbase, MS, and MicroStrategy, something definitely to take a look at. All right, let me get. Yeah, I don't know what's going on with Binance here. Something's going on with Binance. Max P. Hi, Jeremy. Thoughts on regional banks, USB, Bank of America. Here, let me throw that up on the screen for YouTube. Yeah, I got a lot of opinions on this. I've been thinking about it. What are the possibilities that can happen here? Let me take a drink. So this is the question, and feel free to ask your questions as much as you want. We have a long day. It's Friday. We got all the data in. We kind of know what we're looking at now. All right, we do know what we're looking at now, and we're going to get to CNBC too, but I want to definitely want to answer these questions. So let's take a look at KRE. Your question is thoughts on the regional banks, USB. What is USB? USB. Okay, this is US Bank Corp. All right, US Bank Corp. Bank of America. I don't know, but I don't think Bank of America is in this mix of risk. I don't think I wouldn't put Bank of America. Bank of America is one of those big too big to fail banks, right? It's one of those too big to fail banks. So I wouldn't put in the regional banking category, right? The risky category for the treasury collateral collapsing. And you also say they look attractive right now for the long term, but there seems to be more uncertainty ahead. Yeah, there is more uncertainty ahead, and either way, they're going to be saved. I think. I would focus on. I would definitely focus on KRE, right? KRE as the risk barometer. If this thing starts to roll over, then you definitely do have some risk coming into the market. But I still don't think it lasts. So I would wait. I would just wait. I would stay, I would definitely stay tuned and just wait to see how this plays out. You have a clear pattern here on KRE as we've been pointing out, right? You got a clear pattern. So if it starts to get above 42, right? If KRE gets above 42, it's sort of signaling risk off because the market's a lot faster, a lot quicker than we are at digesting data. Price action is telling you what's happening, regardless of what people think about price action. Well, it doesn't matter what you think because if the price is going higher or lower consistently, then your theory doesn't matter. Obviously, you're wrong about something or you're right about something. So once we get above on KRE 42, maybe those risks aren't there, right? And that's probably going to coincide with some type of program or something that is supporting the bond market because the bond market needs to be supported in order to get rates lower, real rates, not real rates, but bond market rates, not the Fed funds rate. Now, if we slip below, 39 or below 40, then you got risk off. So I would stay tuned if we get above 42. It could be now, me personally, I'm not interested in banks. I think there's much better, opportunities than getting in these banks. But if you are, you got to get, KRE above 42 or because they're going to get saved. Or if it does collapse, just wait for the Fed to step back in and start another program. That's what I would say when it came to the banks. Now, USB Bank Corp. Right, US Bank Corp. Oh, it does look a lot like the regional banks. This is probably the same play here. Looks a little bit like the same play. Obviously above 33, so I don't know if you can see that, but above, let's make this a little bigger. You got some consolidation here above 33, 33.75. So yeah, we gotta hold here. Let me throw those simple moving averages on, see what they're looking like. Yeah, I would wait. I don't know. I don't, like I said, personally, I don't think this is the greatest setup because a lot of the banks, I'm just not a bank guy. I'm just not a bank guy. I'd rather be in crypto because I think a lot of these things are going to get solved and they're going to be buying crypto. You can look at Ethereum as a bank because it's going to yield you. What happens when there's an Ethereum ETF? These are just my side thoughts. What's going to happen when there's an ETH ETF that yields 5%, right? And the collateral is going up, obviously, because it is a smart contract burning supply with lots of demand. I think it outperforms all these banks by far because of DeFi. A lot of reasons why you could do that. That's not even counting what ETH actually does with smart contracts. Now, besides that, yeah, I would say if you're looking at US Bank Corp above 33.75, 34, really the hold of 34, that big whole number is going to be a good signal there. But there's so many other factors going on. You have a lot of other factors coming on here. So it's really hard to tell. Technicals, I think, in this situation aren't going to be as important as with the US Treasury and the Fed, how they solve this issue. I think that's going to be more of another factor. I wouldn't just buy the dip just because, hey, they might jump in. You just never know. You just never know. Bank of America, though, I don't think they have that issue. Bank of America is probably a good buy. Like I said, I don't really look into banks too much, but it's at 28, high 50. The problem is like these things don't move very much, right? For me, they don't move a whole lot. You definitely got a pattern here, but they just don't move a whole lot, which is cool. If you want low volatility, that's great. The issue I see here is if you're going to maximize your returns, right? Coming out of a bear market, um, the volatility is to the upside. We're going to get more to the upside, I think. So I would say if you're already in a bull market, then yeah, Bank of America could, if we're at all-time highs, Bank of America could be a place to park your cash. Hey, there's a nice wedge pattern though. You got that wedge pattern. So BAC is a lot better, right, bro? If we break above this wedge, we're going to be grinding higher. If we break below it, then the probability is lower. And then you wait on that. It just really depends on your time frame too. Are you looking out 2 years? Is it a swing trade? Is it 6 months? All those things make a difference. And don't be shy to ask those questions. Tell me your time frame, and then I'll reevaluate it. But for the most part, yeah. What up? Oh, what's going on? Diggs BTW7. You guys got some crazy names on here. Shout out to the chat though. Let's get that going. Support jumping in here again. Yeah. So anybody else, you got anything technically we want to look at as I evaluate the market? We can definitely do that. All right, and then let me get this up there. Let me pin this comment on TikTok so everybody knows to jump over here. There we go. That should be pinned. Jump over to YouTube if you're not already on YouTube. If you want to see the actual charts, if you just want to hear the commentary, that's fine. We will listen. Oh man, big sell off there. Something's hitting the market. I'm gonna switch over really quick to my trading station. I'm gonna switch over to the trading station, and if we don't have anything else, also really quick, check this out. Okay, I want you guys to see this. When it comes to liquidity, we are seeing liquidity. This is the Fed, the ECB, the PBOC. These are the biggest central banks money growth into year over year. Okay. And what you see here, let me zoom in, is when they trough or they bottom, then you can expect the liquidity cycle to turn back up. We've already bottomed, right? We bottomed in the liquidity cycle. This was all 2022 into 2023. We are now starting to rise back up. So year over year, even though that global liquidity indicator looks like it's going to roll over, it is not a stock. It's not an equity. It's not a chart. It is just liquidity. You don't trade liquidity. I'm telling you, liquidity is starting to turn up over the next 6 months. You'll only see more liquidity coming to the market, not less. The US Treasury drain from the TGA is non-existent, and the Fed already acknowledged that. So we're going to see this money growth start to pick up. And I just want to point these out. If we look at this chart, this is another chart of the money supply for the four major central banks, just in line format in a different frame. You can see we went from -5 and we're grinding above 0. This is extremely bullish, and I think it's mostly bullish for Bitcoin because Bitcoin does the best, is the best performer, right? And I think ETH will outperform that when it comes to the globalist liquidity cycle starting to turn, and it's already gaining traction. That ETF is insane. I don't think people understand how big that ETF is going to hit, right? So in the short term, it's going to be uncertainty, but in the long term, right, this is the bottom pretty much. Maybe go to 25K. Who knows? All right, so let's take a look. Taking a look at Zoom here. Where is AMD? AMD is starting to grind up. All right, yeah, we're gonna switch to that other chart. I think we got through most of this news economically. I think we got through most of it, right? A little sticky on the average hourly earnings, but the unemployment rate is low. No recession in sight. Yields might climb, but it looks like yields are starting to peak. Very good signal. We're getting yields start to peak. All right, let's switch over. Any other requests for technicals? Oh no, this is not the chart I wanted to show. Mm, oh, all right, yeah, here it is. And yeah, and I'll keep track of CNBC on the side too. All right, here we go. Here we go. Here we go. We're just consolidating sideways on the S&P 500. So let's give a little little pullback. IWM, by the way, is moving. If you are trading any index, I'm going to throw IWM here on the right hand corner. IWM. IWM looks very strong, right? So those buyers are coming back in. Keep in mind, a couple weeks ago, we had a report that showed record inflows to the small caps. And a lot of that is, these guys missed the big tech rally, so they want to get in. And rates are like IWM, small caps should be weak. They should be weak when rates are climbing, but they're not. So they're defying gravity. That is a strong signal of strength, really, that they don't care, right? Nobody really cares because at the end of the day, ultimately, it's about inflation expectations. So we do have a gap to fill here at 185.78, but it looks like it's starting to break out there. But it's all about inflation expectations, and those expectations continue to fall regardless of what you hear. The headlines on this network or on this network, inflation expectations are falling. So IWM there, nice little setup, especially if you let me go to the 3-minute chart. Nice little setup. Yeah, that is nice. Nice little setup, kind of breaking up to the upside. Not a sure thing. I just really like to chart these things to keep my eye when the opportunity comes. I don't see any monster setups yet. I don't see any monster big time frame setups yet. Just some pullback into support setups. Got AMD here on the right hand side, broke that trend, starting to move back up. Got that PDC support. All right. So, anyways, yeah, getting back to it. So you got IWM starting to lift there, and we already looked at IWM on the bigger time frame. Now S&P, what is S&P looking like right now? What are we looking like on the S&P 500? Here's our level from yesterday. So if we get above this level, we have a couple levels to get above, but yesterday's highs were 440, pretty much 440. Yeah, this was yesterday's high, 440, which was the pre-market. We got a little above that pre-market high, and the opening print, we couldn't get above that. So that's clearly resistance, right? We're gonna work our way through that resistance, or we're gonna come back and retest the pre-market low from yesterday. But grinding sideways, the longer we grind sideways after gapping up, the stronger the price action in general. Now, if we're coming from the lows, that'd be different, but we are starting to gap up from the previous day. So that looks solid there. We'll take a look at Tesla here in the left-hand corner. And again, if you guys, let me switch this banner. Let's get over to market open, technical analysis. We'll be doing some TA, inflation, FOMC minutes. We already went over that the other day. All right, now we got the Qs starting to sell off. So tech is getting hit. The tech index is a little weaker than the S&P right now. We do have we do have tech a little weaker than the S&P. Qs are testing the pre-market lows as we speak, testing the pre-market lows, and it's early. It's early. We're still digesting the data. It's only been an hour, right? It's only been 1 hour into the market, 60 minutes, 70 minutes, if you want to be more exact. And so we're still retesting all that. Rivian share is set to pop. Yeah, Rivian's probably moving up. RBC says stocks can rally more than 50% to strong fuel. Okay, fuel cell demand. Meta threads. Anybody try the meta threads yet? Are they called Instagram threads? Whatever, same thing. China investing. Okay. All right. What are they saying here? Meta Twitter's threads rival. Okay. So Meta's Twitter rival Threads explodes to 50 million signups 1 day after launch. Wow, that was pretty quick. 50 million signups. Well, that was a weird way of saying it. That was weird. All right. So, anyways, yeah, Tesla on the left-hand side over here. We are forming that nice consolidation above 275. So we're still holding 275 there. A lot of support. We're getting some buying coming in there at 275. And let's look at this 3-day chart for Tesla on the right-hand side. I'm not trading today. I'm not trading. I mean, if there's something there, I might trade. But for the most part, I think there's a lot of news that needs to get digested. And inflation comes out next week. You got to pick your spots. People overtrade a lot and they lose a lot of money. Oh no, I don't want to see that. Okay. So yeah, we got the Qs. We got the Qs. Yeah, the Q. We definitely have the Qs though. Overall, with the pullback, it looks like the Qs try to break out of this downtrend, right? If I dive a little deeper, it looks like the Qs did try to break out of this downtrend, but that might be just too short term to really tell if that's going to carry through or not. So back to the 3-minute chart. Let's take a look at Meta. I know Meta's been moving up. Let's see. Maybe the threads is has been a catalyst here. Maybe in pre-market for Meta on the left-hand side. No, not yet. Not yet, but it is forming a pullback pattern. Meta, Amazon, Google. I don't see anything. A lot of chop in the market, man. There's a lot of chop in the market. Apple, any patterns setting up for Apple? And two, the overall market's pretty choppy, right? SPY is pretty choppy. Do we got any request here on the technicals? Meta threads. What are meta? It's like Twitter. Meta threads is basically rivaling Twitter, right? Same thing. You know how you do threads on Twitter? Same thing, but it's Instagram. Same setup. I actually made my account yesterday. Go follow me. Go follow me if you want to hear my new threads. I'm gonna start tweeting on there. But what do you call it? Do you call it tweeting? I mean, it's not really tweeting, right? I mean, it is tweeting, but do you call it tweeting? Insta tweet? Oh, advanced decline. Man, this is actually really strong. And I just noticed this and this is why it's good to have a lot of these indicators. Advanced decline is up today pretty strong. We're at a 1,300 stocks advancing versus declining. So it is a strong day. We just don't know where the strength is coming from yet. I haven't looked at my filters to see exactly where the strength is coming from because I think the macro is important to digest going forward. And I want to know that first. I want to see if there's any big setups here. So Apple, Amazon, MSC, Microsoft selling off too, right into the trend, right into the uptrend. Okay. Netflix. Always taking a big look at mega cap tech first. I always want to see what mega cap tech is doing. Is there any outliers here? Google, nothing. Really nothing here. What about Carvana? Oh, Carvana is squeezing. Now, I know we pointed out Carvana like 2 months ago, like, hey, this could be a big short squeeze way back in May, and it started squeezing. Now it's forming a bigger pattern. Um, looks like it's starting to it's trying to break out here. Carvana is not a good company to invest in my view, but there is a huge short squeeze taking place, and I think that just continues. Looks like there is a nice little bigger pattern on Carvana here. Let's see what it looks like on the 3-minute. No wedge, but it's climbing. Wow, this pattern looks exactly like the daily chart. That's very interesting. Looks exactly like the daily chart. Look at this nice pull into VWAP in the break of that trend. What else we got here? Any technical analysis on anything before we move over to the to hear a little bit more about what's going on? What do you guys want to hear? Let me know. Throw it in the comments if you're on think about what you want to hear about. You got any questions? I know it's a really very confusing environment. Throw your questions out there. Give me some comments. Give me some criticisms of my view or some things that might, shake things up. But let me know. Let's talk about this. Let's get through this on Friday. We have a lot to digest. I'm going to come out with, my take on things tomorrow. I'll be live tomorrow morning going over all the macro data for the week, all the sentiment indicators for the week, and just kind of give you my view. I'll do that tomorrow morning live. But for now, let's throw it out there. Let's see what you guys want to hear about and what you guys are listening to. $50 million signups. That is pretty big, though. 50 million signups really quickly. Hiring slows more than expected. Who is this guy? Is this guy giving his comments on the labor market? June non-farm payrolls, labor participation. All right, so we do have some. We have some commentary. Market alert. We have some commentary on the reports here. So let's check out that commentary. Yeah, Carvana looks pretty nice. That's a nice it's a nice breakout there. On the right hand side, who else was it that people are looking at? Airbnb. Oh, you might want to short Airbnb going forward. Actually, I don't really know. I don't have a big thesis on this. I don't know how the dynamics are, but I know Airbnb is set to lose a lot of money. This could be a short, but it's not my type of play. Definitely not my type of play. So I'm just taking a look at it and saying, hey, are we going to see any patterns setting up as the Airbnb thesis falls apart? Where you at, Bukowski? Where you at that they're not showing up yet? Were you in China, bro? You live in China? No, I'm just kidding. I don't know where you live, but that's interesting how they wouldn't show up yet. Okay, so Airbnb. You guys know I'm looking at ZM here. I'm still waiting for this big pattern to rip. It's been rolling over on me. Once Tesla takes off, I think ARK will lift. So I'm keeping my eye on that. But I do like ZM here. I really do like ZM as a longer term play. But I'm looking far out. There's no confirmation till we really get above 70 and hold. We have not been able to hold above 70 at all. But I would definitely do that. Okay, what else we got? ZM's where Open Door pulled back. Open Door had a big move to the upside the last couple of weeks, and it did pull back into that previous support. Actually, it didn't even get there. 350. Didn't even get to 350. Excuse me. Didn't even get to 350, but it seems like there's a lot of allergies going on. Been sneezing a lot, especially here in Arizona where it's dry. What about snow? How does it relate to the housing market again? Oh, snow. I don't think snow relates to the housing market. A lot of people like snow. I'm not a fan. I have a couple friends that like snow. I'm not a fan of snow, but I might just be biased because there's always that talk that they compete with Palantir. Mm, but yeah, I don't really have a view honestly on snow. I really just don't have a view on snow. Maybe they are, maybe they're legit on a technical basis, right? Looking here on the right hand side, on a technical basis, they have broken out of that wedge and they're starting to support the previous highs. So let's say you got long snow, some long 6-month call options. Maybe your stop is below 166. Once you get below 166, it's there's no support until 150. Not an acknowledgement, but yes, for snow 166, 166.50, and then 150 would be that next one for snow. So, but I don't know their thesis. I don't know what's really going on with snow. Whales are doing with snow. Looks like there's a lot of whales coming in here. I don't know. I don't know much about snow. Back to the S&P, what's going on? U.S. natural gas storage, 72 billion. President Biden. Let's see what he's talking about. This jobs report. Biden. Oh, Biden. Biden says U.S. jobs report shows Bidenomics in action, continued growth. I know people don't want to hear that, but forget the politics. He is right. He is right. The Bidenomics are holding the economy apart. Not to say that it's like his ideas, because the dude's practically brain dead, but the Biden administration is actually doing a good job of holding the economy up, and then draining that SPR to put more supply of oil to lower prices. That's actually a really smart move. Doesn't mean Biden's the showcase for it, but either way, hey, that's a smart move. You got to take your bias out of the way, because the economy is way more important than that. Way more important than what you think someone should be or should do, right? Am I a fan? No, but I mean, I'm a fan of a better economy. And either way, anybody in there would have been smart enough to do that. And everybody thinks it's inflationary, but it's really not. It's not inflationary unless it's really just not inflation. Now, checks, if you give out straight checks to people, that's pretty inflationary. But if you're providing jobs, it's not really inflationary, because you're producing more supply onto the market. CVNA really moving there. That's nice. What else we got? Norway. Oh, you're okay. So you're in Norway. Wow, really? There's no interesting. There's no threads in Norway. You're gonna have to hit up Zuck and ask him what's going on there. All right, I'm gonna play this if you're on YouTube really quick to hear what they're saying about the labor market, and then I want to hear their view on the labor market and see if it kind of matches what we're thinking here also. So you should be able to hear it from this tab. Let's hear what he has to say.
My take on this number is a little less steady, maybe the best way to put it here. If you think about the trajectory of jobs, it has been coming down. It's still slower. It still remains strong at a high level at plus 200,000. Remember, we're bringing 100,000 into the workforce every month in terms of population growth. So 200,000 says we're still running relatively hot. The wage number suggests we're still pretty hot there.
Bukowski, when do I think higher rates will really start to kick in? I think they won't really start to. It usually takes like 12 months. So I think second half of the year they start to kick in. I don't really know for sure. I'm not like a super expert on that, but from the research I've done and some of the work suggests that those higher rates will kick in maybe like the fourth quarter. Yeah, maybe like the fourth quarter. And that's also where I think we start to get liquidity picking back up as those rate hikes take place. So yeah, I would say fourth quarter, maybe even Q1 of 2024. We might not even see the rate hikes take place till 2024. More importantly, it's going to be, the liquidity is going to be that Fed's balance sheet. If the Fed's balance sheet keeps draining, I think that might be the bigger issue versus the actual rates. If the Fed starts eating up more treasuries, which I expect them to do, and the balance sheet goes up while rates are high, then really a nothing burger. But yeah, they'll probably kick in. I just don't think they impact everything, right? Some things are going to get impacted pretty hard. Commercial real estate's already pretty weak, but for the most part, I think we'll be fine.
So there's the number. You can see it's a little harder to see. But guys, if you go to the next chart, you look at the 3-month average chart, you can see that 3-month average coming down. It was north of 300,000 at the beginning of the year. And then it's down now to say, call it 244,000. So there's what the Fed is looking for. But as they've said in a lot of commentary, Carl, it's not coming down as quickly as they would have hoped here. So there's less pressure from the job market, but maybe not quite as much less pressure as the Fed wants.
Steve, how much is the Fed paying attention to just those non-farm payroll levels versus the wage growth? I mean, does it matter if wages are still rising?
I think it matters. It matters on the surface, or at least in the initial go round, that wages are still rising. But what the Fed's going to want to see is productivity and whether or not that offsets the rise in wages. And my idea is this: is we put a lot of people to work in the past year. We've had a bunch of new immigrants into the country. We put them to work. I think that may have an effect in terms of productivity. In the first year, you put somebody to work, they're not so productive. Give them a year on the job, and they'll figure out a way to do their job better and more productively. So I think that right now,
I don't even think the Fed, Tom Lee mentioned yesterday in a Twitter Spaces that the Fed doesn't even care about ADP payrolls, right? Not that important. They when he used to work at JP Morgan, he said that they called it the random number generator. So yeah, average hourly earnings are going to be a better way to track the wage inflation if you even care. But I did want to answer a couple of these questions. Higher rates. SPY finally trying to break out and Meta trying to recover. I see you out there, Norberto. Angel, they have their bot enough workers. They have theirs bought enough workers. Sorry, don't understand that sentence. Make it a little more clear, please.
Now the wage gains are troublesome, but perhaps over time, after we've put all these people back to work, shifted people around, there's been a massive churn. They call it the Great Resignation. There's been all kinds of things. I really think of it more as the Great Reshuffle. People in new jobs, people in new companies. Over time, we could see a productivity boost in addition to maybe this debate about work from home helping as well.
And Steve, I think I saw that the prime age labor force participation rate in this latest report is the highest it's been since like mid 2001. So that you've seen that supply response, people in the workforce. I don't know how that feeds into that productivity idea, but it does suggest at some point that you can almost have this mission accomplished moment where we did essentially soak up that labor supply. And now it's a question of, how much we can grow from here without it being, further inflationary, I guess.
Well, after mission accomplished, you know what they asked, Mike, which is, what are you going to do for me next? And there's a big question here as to whether or not where the next chunk of labor of workers are going to come from. We may be running out. We had, I think, a good influx of immigrants as the Biden administration moved to normalize immigration post-pandemic, at least the legal immigration side. We can debate the other side, but the legal immigration side was normalized by the Biden administration. And then you have this huge, as you know, outflow from the workforce among retirees. That's where some wage pressure might come from, which is, what would it take you guys? I'm asking you, Carl. I'm asking you, Mike. If you were about to retire, if they said, no, here's another chunk of money for you to stay in the workforce, there could be some wage inflation from that attempt to keep retirees or perhaps draw them back into the workforce. Because one of the things we've seen is while people have retired, we haven't seen the flow back into the workforce among retirees that's normally out there.
Yeah. And I do know that, the job changing dynamic you mentioned has been a driver of overall wage growth as well. I mean, that is when people tend to be able to maximize their earnings if they're willing to move around a little bit.
Right. And one of the things we've seen now, ADP is a good question. I've been trying to understand the difference in between ADP and the government. One place you might want to look is the difference in the leisure and hospitality numbers. ADP had a huge number for hiring for leisure and hospitality. The government had only 21,000. The ADP number was north of 200,000. Also some differential there in the education and health services number. But one thing that ADP has, which is these wage numbers, they're higher than the government wage increases numbers, but they've been coming down both for people who are staying in their job and for people who are changing their job.
Interesting. Okay, so we have seen some of that moderation. Steve, thanks very much.
Pleasure.
All right, joining us now is former Fed Vice Chairman Alan Blinder, now a professor at
Okay,
Princeton.
so yeah, really nothing. The same thing that we've been talking about, which is more people are coming into the workforce, and that creates more supply. I think this is overall bullish. So when I look at the charts, right, coming back out of here, take a look at the charts. I expect the S&P to basically eat this data up. And this is S&P on the right hand side anyway. Look at it, S&P is in a wedge from the pre-market lows. It's starting to wedge here. So you Norberto, we are looking solid. And looks like we're going to break that wedge. Well, I don't know if we break it. We're holding VWAP. We'll see what happens. 440, we get above 440 and we start to climb to fill that gap back to the upside. But the big level is 440. If S&P can get above and hold 440, it has a little more resistance, but 440 is the level from yesterday, from the resistance from yesterday. So 440 is going to be that big level. Can we close the gap at 443? That would be a nice trade. And you also have IWM just ripping higher, back to 185. Advanced decline ripping higher after this report. VIX is back down to 14 after it jumped to 17 yesterday, right? So that was just a quick relief. We thought it'd be a relief and then we'd come right back down. And that's exactly what we saw. So turn this off, keep going here. Yeah, so this is a Fed guy. Okay, yeah, he's gonna talk about the jobs report. Anyways, yeah, S&P is looking solid. I do have CVNA over here in the right hand corner. I think there was another setup on DAL. Nice little wedge there, but I don't like that. Never would trade that thing. S&P, watch S&P start to test that 440 level, by the way. All right, and how will it affect everyday Americans? I read few have free flow mortgage rates, and a lot of us in Europe has so like variable mortgage rates, free flow mortgage rates. Does that mean like you have a variable rate? Your rates are variable, like obviously they change with the rate. Honestly, the rate hikes, effects of the rate hikes come into effect later, as in rates are just you don't really get that effect. You don't really get people struggling, not even people. I think it's more for business, right? The rates for people are happening now. So like if you have credit cards, if you're trying to get a mortgage, those rates are affecting you now. But for businesses down the road, the lag effects affect the business the most. Again, we might not even have higher rates later. Those rates the Fed could very well cut rates if inflation comes down enough. In Europe, I don't know. In Europe's a little tighter. Their inflation is still a little more persistent. And so that's going to be a different story. But for Americans, I think they're going to be okay. The housing market's already starting to turn back up. There's a little more, there is demand in the housing market. We're seeing that demand in the housing market come. It's not wild demand. It's not like crazy demand, but it is coming from the lows. So we're starting to see demand in the housing market, and with rates this high, so rates will only come down. You just really keep your eye on the U.S. Treasury market. That is the big signal, right? That is a big signal. When does it come down? Is it at the peak now? Are we starting to peak out again? When it comes down, rates will come down, and there will be more buying into the housing market. But prices are coming down. So I don't know if the Fed's rate hikes are going to affect everyday Americans. I just don't know. I don't think that's a real corollary. I really don't. What affects, because everyday Americans are still spending on services. They're not buying goods. So it would hurt them when it comes to, vehicles or, mortgages. But I think for the most part, they're just staying where they're at. They're not selling their houses. They're staying where they're at because they don't want to, pay for higher rates. And they're just spending their money, their savings, whatever it is, on right? So that's sort of what I see happening. Maybe, that maybe 6 months out is kind of far. There goes S&P is testing that 440, by the way, starting to break. They have their, okay, there we said there's not enough workers. There's not enough workers. Okay. Not enough workers in the labor force. Probably true, but they are coming in, right? They are starting to come in a little bit. Job openings were pretty elevated. They're coming down. So yeah, there's not enough workers. Let's see. With that 63 retirement, mama didn't raise no fool, go crypto, learning something new. Yeah, yeah. A lot of people retiring, baby boomers retiring. So you need a new pool of workers. That's where AI really comes in, right? That's where AI comes in and starts to take, and it's super deflationary. Anyways, S&P is looking good there for the breakout. It's above 42. It is now above 44. My bad, 4,400. Carvana is still climbing. Advanced decline still going up. It did pierce through the 200 moving average on the 1 hour, but I do want to see the 20 and 50-day moving average to close the gap between themselves on the SPY. I never look at the 1 hour. See what that 1 hour looks like. Heck, that's not the 1 hour. There we go. Yeah, hey, I'll be right back, Paul, to answer your question. Let me get a little bit more water here. Yeah, I'll be right back. All right, so that 1 hour chart. That's weird. I wonder why that comment didn't pin. There should have been a pinned comment. Nobody sees it. Oh well. So we got Paul here. Businesses are smart enough and financial. Here, I'll just put it up here. Businesses are smart enough and financial products are more advanced when they should have hedges in place to protect against rising rates, rate futures, option swaps. Okay. Yeah, I think businesses are a little smarter than the overall market because they kind of know what they're doing, right? They do know what they're doing. Tom Lee mentioned that a lot of stocks they invest in actually use them for financial services, which is very interesting to to hedge and all that. A lot of the banks got screwed. I don't know if you're kind of hinting at this, but a lot of the banks did get screwed because they bought a lot of treasuries, at the top. So their collateral, they use treasuries as collateral for lending, and that fell, which gave them a lot of risks. But I still think that at the end of the day, the Fed's gonna jump right back in and start buying those treasuries at some point. When they have to roll those positions over at higher rates, then they'll feel the effects of it. Yeah, very likely. A lot of if you're talking about banks, I do agree. Equities, possibly. I do know stocks, a lot of equities or a lot of companies just sell their own debt. That's why we look at the triple B spreads to see if there's buyers coming in for that debt. Now, they're not all doing it, but for sure there is risks. There is a lot of risks in the future when it comes to rates. But I think they're realized already. I just don't, unless we get more surprises, I think the equity market's going to be okay because it's more concerned with actual earnings. I think earnings are going to be a bigger factor, Paul, when it comes to what are the real risks. If earnings are bad, then yes, but if earnings are better than expected, and there's so many things that can happen with earnings, right? You have incomes, you have guidance, you have margins, you have different debt balance sheets, equity. There's so many things when it comes to the earnings report. So I think when it comes to the stock market, it's going to be a stock by stock or a stock pickers market, right? Some of these equities will have a rough time over the next 6 months, and others will take that market share and outperform. That's my view on it. I wouldn't look at them all equities as the same, but I still think mega cap tech continues to outperform, getting to all-time highs by the end of the year. The marginal borrowers right now already feel the effects of higher rates. Yep, very true. PSNY is turning more bullish than I expected. Is it PSNY? Take a look at PSNY. Well, actually, let's keep this in for, let's keep our eye on S&P, because if it breaks higher, we're going to see some movement here. I'll put PSNY on the left-hand side. PSNY. It's at 450. This is the EV play. Wow, yeah, this thing is starting to lift from the lows. I think you got in down here, right? Like at 350. You were in at the lows, so you're up like 30%. Nice. It's at the top of that megaphone pattern. I don't know if I really believe in these type of patterns anyway, but that's nice. PSNY. EV play, right? Europeans, is it a Swiss European play, I think? What else are you worried about, Paul? Bukowski? Paul Alger? I wonder where you're from. Always want to know where my viewers are coming from. What up, Ben? All right, hiring slows more than expected. Man, they're just saying the same. They're just repeating. I want to hear some market analysts. I want to hear something a little more clear here. Okay, Twitter threads, whatever. Full speed ahead. Full speed ahead. This guy thinks the Fed's going to start hiking because of this. Man, I think it comes down to inflation. The Fed does not care that, Teen Summer. The Fed does not care that the labor market is strong. They care that the wage inflation is tame. And right now it is. It's at 4.5%, 4.4%. It's been holding there. On a month-over-month basis, I guess that could be a little negative on the month-over-month basis, but all right, now, yeah, S&P very clear where the breakout is. 440 didn't hold, right? Getting rejected, no hold on 440. Tesla, is there any opportunity in Tesla? I got this thing marked up so much. Let me clear this. This thing is way too clear draw set. Clear draw set here. Yeah, this thing is marked up a lot. Anyways, back. I'm Seattle, but from Guam. Oh, what up? Okay, that's what's up. Dimaj up 30%. Shout out. Yeah, I gotta get this the Stream Deck working so I can hit the buttons. Instead, I have to click. For now, I have to click on this other stuff. Eventually, I get the Stream Deck, but S&P goes to retest 440. Did it get above it?
Nope.
Nope, couldn't get there. Yeah, I don't have too many buttons on this one. I got to get that Stream Deck working. Waiting for the report. Let's get off of this. Something interesting too that I was listening to Tom Lee. He was talking. What up, Broken Testicle? What a funny name, man. Every time I got to hit your name, it's a ha. Oh, I don't have that button. Got to add it on there. But see if I can find it. Any setups here? No, not really. I'll keep that up. Three sequential. This guy, man, Eric Basmajian, he's always talking about recession. But it's really hard. It's really hard when the Fed can just print money behind your back, BTFP. and they can lower rates. Bank of England's inflation expectations are still anchored. Okay. I don't care about Bank of England. Fear greed index, crypto, fear greed index. Nothing too big there. Whoa, what is this? Well, looking ahead to next week, it's really interesting. This weekend on Sunday, we'll get Bank of Japan lending year over year. We'll see if they keep lending because they're lending right now. Their lending is how we're tightening our lending, they're expanding, which is why I remain bullish. The Japanese and the second and third biggest economies are still in QE, basically, right? Japan's inflation rate is 0. They can keep printing. Monday, we get consumer inflation expectations. We get a bunch of Fed speak on Monday. Bostic, Daily, Mester, Barr. We get a lot of Fed speak on Monday. And everybody's going to ask them about this labor report. And they're going to just repeat the same thing they've been repeating, which is that, inflation risks are still elevated. But, oh, you get Bostic too? Okay. Or I guess I already said that. Bostic is the dove in the room, I believe, from Atlanta. Tuesday, we have Bullard speaking. He's usually pretty hawkish. NFIB Business Optimism Index. Okay. And then we get the inflation rate on Wednesday. That's really what matters. Wednesday and Thursday, because Thursday is PPI, right? We get PPI on Thursday. Where's PPI at? Oh, PPI is not. Oh, yeah, no, it is on Thursday. Yeah, PPI on Thursday. So next Wednesday, Thursday are going to be the real big data. That's why I think right now you're just consolidating in the market. Nothing too big in the pipeline because we're waiting for those reports, right? What is going to happen here? What are the big setups too? I'm still eyeing Tesla over here. I had to take those off. We got a gap at 282.50. We're still in the uptrend. Let's draw this uptrend for Tesla. We're still holding. Yep, we're still holding this uptrend. So we could trend sideways into this before we move higher. Quarterly moving averages. Let's see what else we got on the comments. But yeah, let's keep talking macro. Throw out your ideas. Any CFA candidates in here by chance? Anybody a CFA in here? Not me. Max 1 week. There we go, the weekly. So this is the weekly. Weekly. Very bullish on the weekly. We do have earnings coming up, though. That's going to be big. So S&P is still struggling there. Let's see if they have anything. Playbook for autos. Hey, there is a lot of people, there's a lot of buying happening in the auto sector also. So growth is just holding on here. Morgan Stanley's top 6. Is Lucid getting pulled up with Rivian? They both look set. I know there was some. What is the Lucid? What is the LCUD? I don't know what Lucid is. There it is, LCID, Lucid Group. I heard that Lucid, there's some rumors that Apple wanted to buy Lucid. I don't know if it's actually true. I wouldn't trade off that, but it does look like it's starting to break. There's probably just really a lot of EV optimism from all the fiscal policy and all the global government policy to support electric vehicles. I think that will lift these stocks for a while. So Lucid and there's a hum noise on your YouTube stream. You guys hear it? There's a hum noise. Is it still there? Thanks for pointing that out. Is Lucid getting pulled up with static? Huh. Just stopped. That's weird. Yeah, I wonder if it was it's back. What the heck? Huh. Technology, huh? Static noise. Okay. Yeah, sorry about that. I'm trying to see if I can let me take off. Let me try to see if I can reset this mic really quick. No, I think there is static. I appreciate it pointing that out. So I'm gonna unplug my mic. I'm gonna turn my mic off and then turn it back on, see if it fixes it. Check 1, 2. Still staticky? Okay. Well, hey, thanks for the heads up. I'll just have to unplug my mic. Yep. You said there's it is still staticky, Vaughn? Is that what you're saying?
Oh, it came back.
It came back. What the heck is going on?
Move it away from you. Right there, and we have to wait 10 seconds to check.
All right, let's see if we could fix this up. Maybe it's just too close. Some people say yeah, some people say no. Is it true that Mercedes is also joining Tesla's charging network?
That's good.
It's good. Okay, maybe it's too close to my face. I don't know if Mercedes is joining. I really don't know. Anybody want to confirm that? I mean, eventually, I think everybody's gonna have to join the charging network. Hey, appreciate it, guys. I think everybody's gonna have to join the charging network at some point. But it is good news, right? If that is the case, it pushes the stock up a little bit. But ultimately, we're just looking out for Tesla to continue to execute. And I think everybody has to join the. Remember a couple of years ago, if you guys remember, nobody believed in Tesla's charging network. They thought it was so silly. Now everybody's like, that's just a really macro signal that, hey, they have the best technology by far, bar none. And I know I'm biased, obviously, but all the bear arguments just keep disappearing, right? They do have the best revenue growth, the strongest revenue growth year over year. And best-selling car, Model Y. We got Cybertruck in the pipeline. That's going to be extremely bullish for Tesla, right? Cybertruck release, very bullish. If they get FSD, the stock doubles in my view. You get full self-driving, which I don't know if it really happens this year, but if you get just the sentiment or just the new how would you say this, the catalyst that full self-driving could be confirmed according to regulators, that could drive the stock up a lot. But if it actually does get passed, I think that doubles the stock in like 3 months, full self-driving. But who knows? That's really uncertain at this point. All right, what are they talking about here? Mortgage rates soared to highest level. Okay, so this is a mortgage rates lady. She talks about mortgage rates. Let's listen on to her. So those of you who are asking about mortgage rates, let's see what they're talking about here. How many of you guys worked out this morning? What'd you have for breakfast? Did you guys get a healthy diet this morning? Or is it Friday? You taking the day off? All right, let's see. Can I do an analysis on the dollar? Yeah, 100% I'll do an analysis on the dollar. I will do that. Here, let me put this pin up there. Or pin this comment up there. I'll do analysis on the dollar. I just want to hear what this lady's saying about rates. She's the top rates analyst. No, I'm just kidding. She's a mortgage. She always talks about the housing market, and I think she's pretty respectable.
On home prices. Hi, Diana.
Hi, Courtney. Yeah, moving patterns are actually holding, but home prices are weakening in some of the still hottest migration markets, in part because of higher mortgage rates, but also due to the demographic makeup of those moving in. Now, this according to a new study from Bank of America. Take a look at the top 5 markets for population growth in the first.
Ooh, look at that. I know she's talking. I just want to interrupt her real quick. Tampa Bay. So this is 2020 to 2022. We got the biggest moves in Tampa. I actually wanted to move there. Tampa, Orlando, Austin, Phoenix, Las Vegas. I live in Phoenix. Oh my goodness. Monstrous. Dude, so many people. It was insane how many people, like the roads were packed. Man, a lot of people moved here. So 2023, Austin is down. Tampa's still up. Phoenix is normal, but it looks like a lot of people moving to Florida.
2 years of the pandemic. That's Tampa, Orlando, Austin, Phoenix, and Las Vegas. These markets all saw home price gains between 30 and 50%. They are all still seeing population growth, albeit about a third as much. But prices in these markets are now reacting differently. In 2022, even as mortgage rates doubled, home prices remained strong in Tampa and Orlando. But Austin, which still has positive population growth, saw prices fall. Vegas and Phoenix saw much smaller price gains. Why? Well, demographics and home building. Austin's inflow is largely younger Americans, many of whom are either renting or buying less expensive homes. Compare that to Tampa and Orlando, where wealthier baby boomers are heading, boosting prices. Now, there was also heavier home building in Phoenix and Austin, leading to more supply, which tempers prices. As for cities.
See, and that's what I've been talking about here. I know it's the Phoenix area, but so you got baby boomers moving on to Austin, Tampa. Obviously, Florida has nice weather, right? A lot of other nice things. A lot of these dudes are moving to. And Phoenix and Austin, I don't know about Austin, but here for sure, like literally apartment buildings are getting built so quick. I'm looking around, just built. So that's why I've also been seeing that Redfin data saying, yeah, there's a lot of builds happening. Doesn't mean it's happening everywhere, but that supply is coming online, prices are coming down, and that could be optimistic for a lot of younger people, I guess, because they don't want to buy houses right now at these high rates. My 2 cents.
With the biggest pandemic outflows, New York, Boston, San Francisco, San Jose, and Seattle. In the first 2 years of the pandemic, prices there gained despite the outflows, likely because of low supply. And last year.
Yo, you probably saw that, right? You live in Seattle, Paul? You said you're in Seattle, Paul, right? So have you seen a lot of outflows? I don't know how you would actually quantify that, but I'm guessing you saw a lot of abandoned houses or a lot of people leaving. I know there's a big homeless problem in Seattle also, but San Francisco, too expensive, man. These are just expensive cities too. New York, Boston, San Francisco, San Jose. Yeah, those are very expensive cities. They're starting to see inflows now.
Those markets still lost population, but prices held positive in New York and Boston, though they went negative in the other 3. That's because pre-pandemic, prices in the West had overheated so much that they had much farther to fall. There's also far less supply in those Western cities, and that's all having an impact on prices. Carl?
Yeah, some pretty interesting forecasts now for some of those Western cities, which I'm sure we'll talk about in the months to come, Diana. Thank you, Diana Olick. Let's get a news update this morning with Contessa Brewer. Hi, Contessa.
Hi there, Carl. The fire on that cargo ship at Port Newark that killed 2 firefighters late Wednesday night is expected to burn for several more days. It's already been.
All right. So, yeah, we'll do the dollar leaving out of the city. Yes, not really a rural areas. Okay. All right. Bukowski, yeah, we'll do that USD. We'll do the analysis on USD. And why do people love the USD so much? Not love it, but a lot of people want to look at analysis on USD. When I do this, I'm going to switch to my macro charts. It's just a lot easier to do the analysis on here, which is my, oh, shoot, wrong. Is basically my Why isn't it showing up? There we go. Okay. Trading View. Yeah, my Trading View platform. Hopefully that's clear. I think that's pretty clear. All right, so let's do this dollar analysis. US dollar. Oh man, the dollar's falling. That's really risk on. All right, so for the most part, the dollar is the wrecking ball. Just to give a little context to it, everything's priced in dollars. 80% of global trade is done in dollars, so the dollar really does matter, right? The dollar is a big deal. When the dollar goes up very fast, it wrecks markets because the cost to trade goes up, and that's gonna shave off a little bit on your trading purchases. And also it's, all the assets are priced in dollars. All the big assets are priced in dollars, which means as the dollar goes up, as the denominator climbs, the numerator, which are the assets, drop in value. So when I see the dollar, it basically is consolidating at this 101 level and 105. Between 101 and 105, it is forming a wedge, or it could just be moving sideways. Historically, when we look at the dollar, it's not really in a down, I guess you could say it's in a downtrend, but this is due to US dollar downtrend it's kind of breaking the downtrend. This is just due to the fact that the dollar is the strongest currency. When people say the dollar is going to collapse, it is collapsing. The dollar's value is down 98%, but the actual index is not going to collapse because it's measured against other currencies, and the dollar's always going to be stronger than other currencies because the US currency is by far the most trusted currency, right? It's not really close. You don't want to hold yuans, you don't want to hold yen, you don't want to hold rubles, you don't want to hold pesos, you want to hold dollars, right? In other countries, they want to hold dollars. Those businesses want to hold dollars. So yeah, jumping back into it, this chart, what I see here. So actually, let's start with the weekly chart and throw these SMAs on these moving averages. We look at the weekly chart, and the dollar it looks kind of bullish. It really does look bullish. It's finding support on these previous highs. Obviously, it's finding a little bit of support. And I think, yeah, 101 is going to be that level. We are finding support at the 100 weekly moving average. There's some support there. So if that breaks a signal, but it's sort of just it's starting to tighten up, right? 50-day moving average is above it. A lot of resistance there. So really it's really neutral when it comes to this weekly chart. We're pretty neutral. And I would like to say it's like a spring. Right now it's starting to load up, right? And what's going to push it? Okay, look, it's very bearish though. On the daily chart, we look at the daily chart, it is now below. It couldn't get above that 150-day moving average. It's already below the 200 daily moving average. So we really had two rejections on the 200 daily moving average, 1, 2, and now we're getting rejected by these. So yeah, support is down here at 101. We could be retesting that. Now, what makes the dollar accelerate to the upside? What it has been is bond yields. It's been yields going up. The cost of capital moving up has actually been pushing up markets, but that has not been the case lately. Yields are moving up, right? But the dollar is actually pulling down. So this is a change in character on the macro forces that I like to call the macro forces. This is a change in character, which means although yields are moving up, the risk is no longer interest rate risk. The market is not, investors not believing that this is interest rate risk, or else we'd be seeing the dollar move up. So I think what's really happening here is, yes, rates are going up. So that means there's cash flow leaving the bond market, but it's also not settling in dollars. Where is it settling? I think it's settling in S&P. I think it's settling in stocks or risk assets in general. We see IWM bidding up today. We've seen crypto get a lot of inflows lately. And so, yeah, that cash is not piling up in the US dollar for sure. And so what I think is happening, and it could be in oil, oil is kind of pushing up. I think what's happening here is when the Fed fully pauses, because they paused, but they didn't fully they haven't yet confirmed the pause. Like, okay, we're done hiking rates. They haven't said that. They're managing expectations. The minute they do, I think the dollar really starts to collapse. If they cut rates, the dollar starts to collapse. If they start more BTFP because the banks collapse, if they have to fund more, because look at March. Where's March at? Here's March. March, FY, is when the banking crisis actually started in the U.S., which resulted in more liquidity resulted in the Fed creating the Bank Term Funding Program. And so when they created that program, they basically created $450 billion of dollars, $450 billion of dollars, whatever. And the dollar sold off. Then it started bid up again. So yes, the Fed's balance sheet is low again, but if there's any risks, they're going to have to print again. Let's say that risk happens, and then maybe we finally do collapse on the dollar here. I own American stock, so dollar decline will affect my yield. Yes, a dollar decline would be good for your US stocks. As far as the price appreciation, the dollar decline will push the price of your US stocks higher. Yeah, that's I mean, that's how I look at it. If you're just talking about investing overall, that's usually the case. So a sharp decline in the dollar usually also coincides with a QE, right? We're back to QE, and that's why the Japanese yen and the Chinese yuan are falling, because they're printing, they're in QE. Yeah, that candle had me worried. Oh, that candle to the upside. Yeah, the candle to the upside possibly. So yeah, I don't know. The dollar hasn't done much for me. It's in that consult. We talked about this back then when it was falling. We said, okay, 101 is support, or 100, whatever, and the break above 105, 106 would be the risk off signal. But so far, we're just consolidating. And really, the signal I'm getting here is, even though yields have been moving higher, their cost of capital, the dollar has not. The dollar has not moved higher. So that is pretty clear that, I think risk, or, cash in general, liquidity in general, is trying to find its way into riskier assets as inflation comes down, as the Fed is on pause or at the end of the rate hiking cycle. And really, as we're starting to see recession risk disappear, the recession risks are evaporating quickly. And as payrolls come out strong, as jobs come out strong, the only downside risk is really the manufacturing sector is still in a very sharp decline. Well, I don't want to call it a very sharp decline. It's slowly declining. Maybe it finds a bid at the end of the summer, because you have a lot of onshoring, right? Onshoring meaning that we're moving manufacturing here to the US. And, that's what the Biden administration has been doing, a lot of onshoring. And that onshoring will support the ISM manufacturing at some point. I just don't see the risk of recession happening. So the question is, how far will yields climb, although jobs come up? It's going to depend on inflation again, which really depends on shelter, which is coming down, as we heard, and oil prices. Those are the biggest inputs. And oil prices, they're it's at 75, or the resistance is at 75. So if oil breaks out, then I think the dollar has some risks to it. I think the dollar could go up if inflation risks come down, go up. So I think really the dollar, at this point, the dollar movement is going to be based off inflation. If inflation comes off the table faster than expected, expect the dollar to move forward, to move down, because people are going to be leaving. Obviously, they're not going to be leaving, but they're going to want to reinvest their dollar somewhere else. And, but if inflation ticks up, then dollar probably goes up. Oil, man, oil is oil. I've been waiting so long for this thing to break down. I think it breaks down though. We'll see when it retests 74. But yeah, there's your dollar. There's your dollar evaluation there. Anything else you want me to look at? Just let me know. I'm going to jump back over here to this tab. Inflation is still too high. Bro, who cares? Who cares? That's what they're going to keep saying. Inflation is too high. By the way, we are getting the Q start to break out. I don't want to see that. There's nothing good there. We are starting to see the Qs move a little higher. Oh, S&P's above. That's why S&P's now starting to support 40, 44. So risk on. Here comes the risk on. Service inflation isn't the reason for inflation persistence. Hey, that's a nice acknowledgement. It's not about service inflation. Service inflation, this is Fed Goolsby. Service inflation isn't the reason for inflation persistence, and it was persistent pre-pandemic as well, whatever that means. Goods inflation is the main rationale. Inflation overall has been more persistent. Goods inflation is not, what? There's a lag to monetary policy. Duh. Why do they just keep repeating this? Inflation is down somewhat, but needs to come down more. Well, I guess you need to watch the video to really get the context. We can get the unemployment rate not to a recession level and still get what? Dude, whoever's tweeting this, they need to check their grammar. That's annoying. I can't read that. We can get the unemployment rate not to a recession level and still get prices down. Well, I think what he's saying there is that unemployment can stay low without and still get prices down. And I think that's what we are seeing. It's pretty bullish. This commentary could be pushing S&P higher. I mean, maybe that's what we're starting to see. Commentary pushing the S&P a little higher. Oh, you know what? I forgot I can do this. Yeah, you're welcome, Bukowski. Keep that Q&A in there. There we go. We'll do some Q&A if we want. Anyways, S&P is starting to lift a little bit. Let's load the trader chart. Oh, it keeps loading that 90-day. Okay, what else are we getting here? Steve Spencer, trader at S&B Capital. Baba, Rivian, Meta. I didn't know Baba was in play today. I guess Baba, yeah, Baba could make a nice move based on the influx of stimulus coming from China. Nice gap up. 3.5. Man, Baba is on fire. 7.5%. What was that news this morning? A lot of stuff coming in for Baba. Baba, PDD. Baba just trending higher. Oops. Not P. Okay, so PDD is not moving higher. I guess it had a small gap up. Small little gap up. Let's take a look at Nvidia. I haven't been looking at Nvidia. Oh, Nvidia is surging back to 428. Nice wedge. Nice little wedge forming on Nvidia, but it's an ascending wedge, not the best setup. Either way, it is what 431 was that 427. Okay, yeah, this was a resistance zone right here. for NVIDIA. Micron. Somebody asked about Micron the other day. I forgot to get to it. What is the date? Oh man, Micron looks like. Yeah, Micron dropped that strong support zone. So Micron is a no-go. Micron is a no-go. I mean, it could keep trending up, obviously, but definitely a no-go now. Unless it breaks this downtrend. Yeah, that's ugly. Micron's been pretty nasty. I like AMD. Yeah, AMD looks pretty solid. We do need to get above 117 again, but we found a bottom. That previous level on AMD. Actually, what chart am I on? Okay, yeah, this is a good chart right here. So AMD did find a bottom, filling that gap. We were trying to get long AMD way back here, but it just kept falling. So we let it fall, finally reversed. I got long at 111. I added again, but it pulled back on me, which was fine. We're in the trend, had a cushion. So we'll see if this uptrend continues. See if we can continue this uptrend for AMD. What else? U.S. equities are some of you guys in if you're foreign. What else U.S. equities are you in? So let me see. You got this for me. Gap. Okay, yeah, this is going to be a little more accurate. Oh, AMD has a really sharp gap at 118 also to fill. Looks like it is starting to form a wedge intraday. Oh, wow. Yeah, that's pretty bullish for AMD on the intraday. Obviously, we need the S&P to keep holding the Qs, and the Qs are starting to lift also a little bit. Advanced decline is now near 1,600 stocks advancing versus declining. The VIX is back below. VIX is back below 14. JP Morgan's top picks going into third quarter. Let's see, what are they looking at? JP Morgan highlights its top stock picks heading into July. Okay, OLN. Dang, this looks good. AMD really looks solid here. Should I add a contract? This might be a good add. Might be a good add. Not sure, but the Qs are lifting. Qs on the right hand side. QQQ. Qs are starting to. I mean, it looks like the S&P. I guess it's not really that different. And we do have resistance ahead, so not fully clear there. But this AMD price action does look good. So top 10 stocks for JP Morgan for July. Dude, how do you have top 10 for July? See what these look like. We'll analyze these guys, see if there's anything good here. JP Morgan top 10 picks. What I'll do is I'm going to put, I'll just keep this here. Actually, no, I'm going to go on another chart. I don't like messing with this. It takes too long. Let's go to this big macro chart where we had Alibaba pulled up. There we go. All right, so their first pick for JP Morgan was OLN, or one of their picks, OLN. I don't even know what this is. So many stocks in the market. Olin Corporation. Well, it does have a Decent descending pattern. But what does this mean? You just go buy it? Like what? Just go buy it. Okay, so OLN, DHR, Donner Corp. Trending higher. Microsoft. Microsoft does look pretty bullish. Okay, Microsoft. Domino's Pizza. T-Mobile, Domino. Oh, Amazon. They got Amazon too. DG, Dollar General. Let's look at Dollar General, DG. It must have some fundamental reasons because, I mean, Dollar General. Interesting. Nice little wedge there for Dollar General, though. What are we up to? Asset printer. We are, well, we got that second jobs report today. Pretty strong, pretty good news. The bond market lifted for a little bit and then it sold off. Not the bond market, the yield. So the bond market actually sold off and then bid up. But basically, I think what we're seeing is, oh, here we go. Bukowski has a little comment. Let me throw that comment up there. Bukowski, asset printer. We are basically watching the S&P, I think, digest the positive news. The dollar is falling for the first time. So we got that. We have the US. Usually when rates climb, the dollar keeps climbing, signaling interest rate risk. But the dollar is no longer climbing. And the dollar actually sold off today, which I think is signaling that there's more risk on appetite in the market for equities or, yeah, for equities, not treasuries. Obviously not treasury. So initially it feels like, okay, well, if the bond market blows up, some guy made a comment the other day, said the bond market's going to blow up. It's going to crush equities. But there's so much cash on the sideline, $5.5 trillion of cash on the sideline. A lot of people on the sideline waiting. And they're going to buy if there's no recession, which is the setup right now, housing market bottoming, consumer stronger than expected, payrolls coming out good, unemployment falling again. I did not anticipate this 6 months ago, 5 months ago. I thought unemployment would start spiking. It's not happening. And that's because of onshoring. That's because we're getting a lot of onshoring, meaning we're bringing a lot of the jobs that we outsource to China or, you know, wherever else onto U.S. soil. And it's creating more jobs. So I don't see a recession in sight, and it's going to come down to inflation. I think the bond market the yields climbing, the bond market coming down. I think yields climbing has a lot to do with anticipating that the hot jobs report could translate into inflation next week, next Wednesday, Thursday. And if it doesn't, bonds sell off. I'm sorry, bonds bid up, yields go up. My real question is maybe yields do stick higher than normal. Maybe they just stay a little higher than normal because who's going to buy bonds, right? You really need the government to step in and start buying bonds to get the yields, to get the interest rate down. But I don't see retail investors buying bonds unless they believe the narrative that we're heading into a 2024 recession. So you should load up now. And a lot of people believe that. Maybe it could happen. But it's not your best risk reward. It's more of a hedge, in my view. I think that's all we've kind of went over so far is that housing market supply lifting in areas like Vegas, Tampa, Florida, Phoenix. And then there's no supply in New York. There's no supply in Seattle, San Jose. And so there's just this rolling expansion in some areas and a rolling recession in others. So anyways, in 3X Bull 20-year TMF, was wondering, reduce it and get into a bit later. 3X Bull 20-year TMF. What's the ticker for that? 3X Bull 20-year Treasury. Is that what is? Yeah, what is the ticker? Do you have a ticker for that? I want to look at that. I want to take a look at it. What it's looking like. I'll say this: there's no sign of recession. Could I be wrong? Could something happen? Yes. So if you do own treasuries, you're just betting that something. You're if it's like 20% of your portfolio or 10%. maybe it's a nice hedge. Something, you get a black swan event and growth really starts to roll over. I wouldn't allocate bonds more than 25% though, in my view, because the data shows that there is no recession. And we know that it's not just the data. We know that there's literally onshoring fiscal policy bidding into the economy constantly. So I don't think we're not going to see that. It has to be a black swan. I keep saying this. We need to see a black swan for that to happen. And good luck betting on a black swan. So these are just 20-year treasuries. Yeah, I'm in TF 3X Bull 20-year treasury plan was to go long for it until interest rate gets cut, but now I'm wondering if I'm going to reduce it and it depends how big it is. I think in my view, in my opinion, it depends how big. Oh, shoot, I didn't even know we're on that chart. It depends how big your position is. I don't think it's a bad position, right? I don't think it's a bad position. It depends. Are you holding shares? Are you holding options? Maybe you have a little bit of hedge in there, right? But the question is, or not the question, but what's happening is there is definitely there's more reward in stocks, but not even the overall market. Maybe the Qs. I would say individual stocks to be more safe. And some people are not comfortable buying individual stocks. That's where I specialize in. What up, football legends? Good. How you doing today? So I specialize in buying individual stocks. I'm not buying an index, and you guys already know what I think is the best moves here going forward. All the catalysts starting to hit. I still think Amazon's a good play. Amazon's a top cloud computing AI network. Microsoft. I mean, I never really do at Microsoft and Apple because they're just the risk reward. Apple, I would say that risk reward is not the best, but Apple actually over time is very good risk reward. Although at this point, heck no, it's up too much. It's breaking all-time highs. It's going to keep climbing. Wait for a retest or wait for you got to grab Apple when there's chaos in the streets. When Apple sells off like 20%, that's when you got to buy it because it's definitely not going to crash. But for sure, yeah, U.S. Treasuries will pick up at some point, especially when they might not cut rates too. I'm definitely factoring this in. They might not cut rates because the market is too strong. Holy smokes, micro strategy must be squeezing these guys. I was waiting for a pullback and we're just not getting it. MSTR just squeezing. Golly, slow down, bro. I wanted to enter this trade. It's not happening. It is just not happening. I'll have to wait till earnings in August to see. Maybe there'll be some negativity in August, but that's the Bitcoin call option right there. There's your Bitcoin call option. It's all good. It's not really good to be long vol on or to play options on crypto anyway. But it's just that short squeeze opportunity is gonna really lift it. How was the report? TMF? Okay. TMF. That's interesting. I never even knew about this. 20-year 3x bull. Hey, that's an interesting bet. What an interesting bet. How much upside do you have on this? Whoa, you get some big upside. I see why you're in this. That's a very leveraged bet there. TMF. Hey, thanks. I didn't even know this existed. Wow. Because it's so leveraged, I would be careful. It is so leveraged. I mean, clearly you have this downwards channel that if it breaks out, then you're straight, right? But I would wait for the momentum to start going before I got into this. But TMF is a really interesting play there. Maybe yeah, that's an interesting play. But wait till it breaks out. And really you want to bit like if growth doesn't collapse, your only other option is that the Fed does cut rates. But are you going to bet on the Fed cutting rates when the economy is so strong? Just keep that in mind. I don't think they're going to cut rates anytime soon. With the economy this strong, there's just less probability they do. Now, the one way they can cut rates is if the economy starts to slow and inflation is low enough for them to at least stimulate growth. That's the other option. So that's my take on that. I just, the macro is shifting and bonds don't look like a good bet for people because the like I said, the risks are disappearing. But yeah, Football Legends, the report was positive. Unemployment ticked lower. Wow, strong economy. Oh, did I miss something? No. Oh, I didn't even see that. Okay. Yeah, the unemployment rate ticked lower. Payrolls came out lower than expected, actually. So, yesterday we got private payrolls extremely strong. And I thought, oh man, payrolls are going to be strong, but they weren't. Payrolls were beneath expectations. Still positive, though. Still in positive territory. Average hourly earnings were at 4.4%, which is an inflation gauge for wages. And it's sticky. It is sticky, but it's not a terrible thing to have wages sticky. Prices paid in manufacturing and services are down. So we'll see how that plays out. I'm guessing the Fed could. Oh, we didn't even get to that. You know what? We need to get to the CME data to see how the market started changing. If the market starts pricing in something different. No, CME Fed watch. There we go. All right. How is the market pricing this in? 92. What was yesterday? Yesterday was 91.8. Not that big of a change. But the closer we get, and again, I don't even think this matters. It's gonna come. This is a 25 basis point hike, 92.4% is pricing in. I don't think this matters until we get the inflation data, which is perfect because you get the inflation data before the Fed meeting. And that's what you want. You don't want inflation after the Fed meeting because it's more uncertainty versus before you kind of can gauge, oh, okay, that was the most important. That's the most important variable, and it came out. We know what it is. The market's going to digest it, and then it just comes down to, does the Fed confirm the expectation? You don't see Fed cutting rates the next few years. Oh yeah, no, Bukowski, they have to cut rates. They're gonna have to cut rates. The reason why they have to cut rates is because we have way too much debt. There's only one way out of this. There's a couple ways they could do it though. If they start buying treasuries, they're gonna lower the rate of interest for the treasury or for the US. They can do it that way. They can do yield curve control where they just start buying a bunch of US treasuries and then they lower the cost of capital through QE. And then they just keep the Fed funds rate up. I don't know if that's really possible, but they could do that. Or so there's a lot of ways they could lower rates. Let me see. If they start buying US treasuries, that would actually be more bullish for you because obviously they're buying US treasuries, right? That's called yield curve control. Also, Janet Yellen has signaled that the U.S. Treasury would possibly start buying back treasuries this year. And she said that back in December, January, maybe even like September, she said that. So that could signal if they're buying back treasuries, that's going to push treasuries higher. But no, they will. Either way, rates are coming down. They're going to come down, Bukowski. That trade is still valid. Don't get me wrong. Everybody's just been so wrong on it. Because we expected the economy to collapse. It just hasn't happened. But yeah, rates are going to get cut because your debt to GDP is way too high. And the overall trend is definitely lower. If we look at the overall 6-month trend, not 6-month trend, but this is the biggest rise. This is the fastest rise in rates in history. And because our debt our debt just keeps getting bigger, these rates will roll over. I think we come back to the 2 percentile eventually. 2%. And technology will feed into that. So we'll see. I mean, I thought rates were going to peak at 2% and then 3%, and they just kept going. But yeah, they can't keep this up forever. They'll eventually capitulate. Just not as soon. I mean, when I start seeing the signal happen, then I'll, obviously I'm going to be like, all right, it looks like the bond trade is back on. For one reason or another. It's either growth collapses or it is the Fed starts yield curve control. They start some program or the U.S. Treasury starts it. Those are the only ways I see it. SPY breaking the 440. Oh, shoot. Okay. when they start cutting. It's a 2-year bet. Oh, 2-year bet. Yeah, you're good then if it's a 2-year bet. They're gonna cut at some point. Yeah, they'll cut at some point, bro. Yep, look at that. Strength. What else? Am I missing some stuff here? We're getting okay, come on, ZM. AMD picking up a little bit. So this is 2 days in a row, right? 2 days in a row. 2 days in a row that we've seen the market sell off, get a little worried, find support, because what the heck? No, we don't need that. Find support because basically the labor market reports are good. They're positive, right? These are positive reports. The economy is starting to recover. We're in this expansion. So we sold off here, recovered, sold off in the morning, sold off in the morning. Oh, maybe this was it. This was last night. No, this was the morning. Yeah. And then we recovered. So we're starting to fill the gap, right? We're starting to fill this gap. And as we start to fill this gap, maybe over the next week or so, we do have inflation in our way, but individual stocks like Tesla, AMD, Microsoft, Meta, the setups or just the technical setups that you're looking at, they should catch a bid during this pull-in as we fill this gap. Doesn't mean they break out though. In order to break out, we actually need the level to break. We need these 4450 level. We need to get above 4450 and start breaking. That's wave 2 FOMO. We get there, we get wave 2 FOMO. A lot of factors to consider, which is why you need to sign up for the macro newsletter. Link in the bio. I think it's in the description for YouTube. I'm not sure, but get that macro newsletter. I will be live tomorrow morning. I don't know exactly what time, but I'll be live tomorrow morning and I will be going over the macro report. So all the stuff we talk about here, if you've missed some of the reporting that we've been doing, some of the market action, catch me live tomorrow. I will be walking through the report and giving my take on it. And yeah, we're going to go through it. So check that out. Subscribe if you're not subscribed to the YouTube, switch over, help me out with the algorithm. Help me to get those. I'd appreciate it. Get the likes up. Let's get the likes up on YouTube too. Likes up on TikTok, likes up on YouTube, and I'll answer your question. And if you guys are live tomorrow, then hey, we're going to probably run into some issue that you're worried about or concerned with, and we'll walk it through. It doesn't mean if you're concerned, I'm going to resolve your concerns. It just means that we can talk through it so that you can process, okay, these are the risks. These are the variables I need to look out for versus what I'm hearing on TV, right? Not that TV people are not smart, but I think there's a lot smarter guys who don't even show up on TV, to be honest with you. I do like Josh Brown, though. Josh Brown is one of my favorites. I like Josh Brown. Would you say, Ranveer, what's your thought on real estate market after the rate cut? I think real estate has, in general, I think real estate has more room to fall. Maybe like right now I'm looking 2024. The beginning of 2024 could be the bottom. So honestly, if they cut rates, the real estate market should start to pick up in residential because that demand, a lot of people are waiting for the Fed to cut rates before they buy a house. They're probably just like, waiting, whatever. So maybe there could be initial fall. I don't know exactly. I'm not that familiar with the real estate market. I just know, I believe prices are going lower before they go higher, and maybe they turn around in 2024. There's a lot of moving parts. So I got to watch the bond market, the rate, the rate policy. Is the Fed going to start buying mortgage-backed securities again? What does the balance sheet look like? So there's all these factors. And as we get closer to it, I'll have a better gauge on what that might look like. But for now, I think prices are just going to keep going lower. Your residents, what up? See you in the chat. So yeah, SPY starting to break. Ooh, I'm looking at this chain link. We'll see what happens here. There's I won't talk about chain link yet. Ethereum's the easier bet. Any more questions and comments? All right, let's see. Oh, yeah, SPY breaking out. SPY's breaking out clearly. Nice. Come on, AMD. Let's go AMD. If AMD should be lifting, I think it will. If we clear this gap, I might just add a contract here on AMD. What is Tesla looking like? Oh, Tesla's pushing up. SPY is elevating. So is the Qs. Wow. Oh, okay, here we go. We got some market commentary here jumping in. Hear what these guys have to say on a closing Friday. We got Josh Brown. We got the lineup with Josh Brown, Steve Weiss. It's going to be interesting to hear these guys. So we're going to comment on that. What's your favorite feature or reason you're invested in AMD? Purely technical. I'm not really an AMD investor, to be honest with you. The only companies that I really understand, if you guys know me, I'm hardcore. If you're familiar with me, there's really 5 picks that I'm hardcore on. AMD is really just a bet on GPUs, or not GPUs, just a bet on chips. And I've been watching AMD since 28. I remember when AMD was $9, bro. I literally got in AMD. It was one of my first swing trades. I got in AMD and I was so nervous. I got in like at $8.75. It went up to like $9, and I was like, oh, it's up too much, and I sold it. And over the next 3 months, it ran to like 15. And I was like, oh my God. And then 20, and then 30. And then the next couple of years, it's at 100. And I'm like, wow. And that's not why I'm buying it, because, oh, AMD ran up one time on me. I've traded it before. But I think overall, it had a nice pullback. It's in a nice uptrend. It's purely technical. It's a purely technical play for me when it comes to AMD. And also, AMD doesn't need the best narrative because it is one of the most traded stocks. And when it catches momentum, regardless of the news, it goes much higher. So it just goes much higher because it's one of those plays. Just like a Tesla, there's so much ammo in Tesla that nothing could be happening. And well, there's always something happening with Tesla, but nothing could be happening, and it'll just be a technical breakout. Versus other stocks, they need like a catalyst. They need a real catalyst. But these options are traded so much. Is this a bullish? I'm trying to see. Is this a bullish pattern here for AMD? I think it is. Do you trade any futures or commodities? I do not trade futures or commodities. The closest thing to a commodity I trade is Bitcoin, because Bitcoin is a commodity. No, I'm just playing. But no, I don't. I don't trade oil. I just watch them. I'm more familiar with equities. I'm just better with equities. No futures, no commodities. I'm better at swing trading. I can do some day trades, but if I do day trading, honestly, it's really tough to do. It's really tough to do day trading. I really got to be focused, and I lose too much if I'm not focused. So, and anyways, I think there's better opportunity in swing trading because most of the market's upside moves happen in after hours, right? Gap ups. And I'm not saying you can't day trade, but I think you need to like scale in your position in the intraday, scale your position in on good breakouts, and get a cushion. And then once you get a cushion, you find support and you really start adding more size, and you just let it play out as the overall market pushes higher. I'm big on the overall market, which is why I like equities, right? Because I can see technology, small caps, Dow, value. I can see all the big overall market move first, and that gives me a signal. If the overall market's strong, then more than likely there's going to be follow through on whatever I'm trading, right? As long as I match it correctly. So that's why I like to use equities versus oil. What is your barometer? What are you looking at? What are you looking at when it comes to oil? It is oil. You're just trading straight up oil. And that's why I like equities better, because they're all connected to the index, and there's all these flows, blah, 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 whatever. And I can get a read also on the RVol, intraday fundamentals, how much average volume is being traded. Not that you can't do that over there. There's a lot of things. I don't know. I'm just better with equities. So we are going to do this commentary. What a big man's coming. Millennial, what's your thought on okay, we read that. Millennials are broke. Gen Z not looking promising either. How is real estate going to survive? Hey, that's a good question. That is a good question. I have a friend who talks about this. He thinks real estate will just keep deflating because of the because of the because of the 3D printing and the automation. He thinks that we'll be able to supply so many houses with our new technologies over time that really you don't make anything on real estate. I think that's a risk to real estate, is that because real estate is, built on what people building houses or all this supply. So once you get like machines building the machine at a faster, quicker, cheaper price, can you really bank off real estate anymore? Maybe off land, maybe land comes back. I mean, I'm just speculating here. I'm definitely not a expert on real estate, so I'm just speculating here, but that seems to be something. Fed's balance sheet is below the previous low, 8.3 before March banking crisis, lifted back to 8.7, now 8.29, so still tightening. Yeah, well, yeah, but that's not net liquidity. The Fed's balance sheet is definitely not net liquidity, so you're right there, Brian. The Fed's balance sheet is it really back below? I didn't know it was already back below. Fed's balance sheet, yeah, it is back below. So yeah, that is that you could call that tightening. There's a guy, he's the liquidity guy. I got to get his name, but he says that, nowadays they change the terms for tightening and easing, and typically before it was liquidity in, liquidity out. And so yes, you're right, the Fed's balance sheet is tightening. This is just net. This isn't the Fed's balance sheet. This is net liquidity, isn't it? Oh no, is this the RRP? What is this? Huh. I mean, this looks like the Fed's balance sheet right here. I think this is net. This might be net liquidity. I'm not sure exactly what it is. Here's global liquidity. It is rolling over. Yeah, so we are tightening. You are right. We are tightening. But and that's a really good comment. I like that. Oh, what up, Beezer? What up, Beezer? Had to check me so I don't trash him. No, I'm just playing. Yeah, no, that is true. And I'm actually looking at this net liquidity. I saw this the other day. It's global liquidity. Here's the difference, Beezer, is yes, the Fed is tightening. They are tightening, but that bank term funding program relieved a lot of the stress in the system. And that's still going into the regional banks or whoever needs to borrow on deposits. So net, we're not in super QE. But when we look at fiscal, right, liquidity in, liquidity out, the government spending is not accounted for in this factor. So if the government, remember back in 2017, and this is only in reference to stock and risk assets. So think of it this way: if I add S&P on here, check this out. And this is only for risk assets. This is the only reason I'm what the heck happened here? SPX new price scale. There we go. All right. So basically we had the Fed's balance sheet declining here in blue. And this global liquidity was picking up at that time. I did not know that. Interesting. Anyways, we had the Fed. So blue is the SP. No. Orange is S&P 500. And what I'm pointing out here is that in 2016, basically Trump said, hey, we're going to, if I get elected, I'm going to cut taxes or whatever. Right. And so the market ran up that whole time while the Fed's balance sheet was declining. It was draining. This isn't a perfect Fed's balance sheet, but it's basically the Fed's balance sheet. So you can still go higher on a Fed balance sheet decline. Also, they were hiking rates. Watch Fed funds. So this is the chart I always reference to, Fed funds rate. They're also hiking rates. Look at this. Let me turn this red. They were hiking rates, draining the balance sheet, and stocks went higher, right? So why? Because this was fiscal policy. So I say that all to say that, let me turn this off. I say that all to say that even if the balance sheet is draining for stocks anyway, and you're hiking rates, equities can still move higher because they care more about earnings, and that fiscal liquidity coming from the government spending was a boost, right? Plus, you had global liquidity picking up, which I think that's what we're going to see also. I didn't even know that. I never put global liquidity on here, but global liquidity was picking up. So where are we getting global liquidity from? China, Japan. Japan's increasing loans and their M2, they're printing. China cutting rates and increasing liquidity. So I know people are still bearish, like they're pointing all these things out. Not saying you are, but that is my counter to that argument, which is I don't think the equity market cares. Earnings are going to be a little more important. And you got Inflation Reduction Act, infrastructure bill, you got CHIPS Act, and you have now the 42 billion. And I think there's more to come. I think, Biden is going to keep printing. I think there's more to come here. Oh, Wall CL. Okay. Here we go. Oh, dang. Okay, so it is dumping finally. It is finally dumping. Wow, that's why net liquidity is negative. We're beneath. Here's the other part. Check this out, Beezer. Yep, true. Banks holding a lot of cash. Yeah. Here's the other part is KR. Can they keep this up with KRE? Look at KRE is dumping, right? Well, it's not dumping yet, but if KRE rolls over, then if we do get the rollover in KRE, which is forming this bearish signal, maybe it doesn't. If it doesn't roll over, still positive because we're not in a recession, right? We're not in recession. People keep spending. And the bigger factor here, right? The bigger factor, even despite the economy, the bigger factor here is that there's so much wealth on the sidelines. There's so much wealth on the sidelines that the payrolls, all this economic data, that is more for rates in the business cycle, right? Are we gonna get lower rates? Are we gonna keep support? Is the economy gonna keep going? And if it really creates sentiment. So if sentiment rises, then all that $5 trillion in the cash is on the sideline is going to go right back into the equity markets as it came out. So there's just so many things to look at. But if investors, fund managers, if they get positive that, okay, we're not going to crash, blah, 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 they're going to buy equities at the end of the day. They're going to put risk on the table. And that's more important. That drives markets, those inflows, right? We just got to keep a track on those inflows. Those inflows are going to drive the market even more. And I think the Fed knows that, which is why they're remaining a little tighter than usual in this shaky scenario. Now it's not even shaky. Labor market is strong, right? And inflation's coming down, which I think is the most key level. If inflation drops to 2.9%, expect that cash to come into the market. Okay, Sagi. Hey, good to see you, Sagi. How you doing? Yeah. Hey, thanks for jumping on here, guys, for supporting me on the YouTube channel. I do appreciate it. I do appreciate it. Keeps me going. So again, like I said before, shout out to the chat. Shout out. And I will be on tomorrow to go over definitely go over the macro report live on YouTube. Maybe I'll do TikTok too. I don't know. We'll see. All right, let me take a little break before we go finish out here in the last segment. Be right back. All right. Oh, some lame music, huh? Market's strong though. Market is strong. VIX is coming down. Right now, let's hear what these dudes got to say on CNBC really quick. Let's go through this, filter this information, see if we're right on track, if we think they're wrong, if they're biased, blah blah blah. Election coming. Yep, elections come, bro. When that election comes, more liquidity. There's so many levers for liquidity to break out. There's so many ways that there's more liquidity coming in. And at the bottom of a market, wave 2 FOMO is coming. Subscribe if you want to hear more. Subscribe to the newsletter. Don't forget to subscribe. Link in the description for YouTube. It should be in there. I believe it's in there. If it's not, and you're on TikTok, you know, the link is in my bio. Also, some of you guys, I know somebody was asking, maybe it was you, Asset Printer, if I could put YouTube on you just push the if you're on TikTok, just push the YouTube button. That'll bring up the YouTube button will bring up the will bring you to my YouTube channel. All right, let's hear this.
Front and center this hour. Did today's jobs report, did it give the Fed the green light to resume raising rates? Our investment committee is standing by to tackle that question. Joining us for the hour, we have a full house. We have Josh Brown, Bryn Talkington, Jim Lebenthal, Capital Wealth Planning's Kevin Simpson, and Steve Weiss. But first, let's take a check on the markets right now. We have seen a bit of a reversal in a few indexes right now. We're seeing the NASDAQ up almost 0.5%, kind of reversing from being in the red just earlier today. We're seeing the S&P up fractionally. However, the Dow is still down fractionally. The big story today, though, rates. The 10-year back above 4% right now at 4.038, just a tick higher than it was earlier today. And I think that's really where we really have to start. Just a short time ago, we heard Chicago Fed President Austin Goolsbee talking right here on CNBC. Our Steve Lee's been doing a great interview. He basically said he believes that a soft landing can happen even with 2 more hikes, Jim. What did you think about what he had to say, and do you think that still is possible?
I do think it's possible. It's actually my base case, Frank.
Yo, imagine 2 more hikes. Oh, do I need to get eye exam? Imagine 2 more hikes and the economy still holds up. Like, that's going to crush everybody's narrative.
Now, I got to admit, I didn't like the 0.4% month-over-month gain in average hourly earnings, but let's see what CPI looks like next week. 1 to 2 more rate hikes. I think the market can withstand it. I think the economy can withstand it. We've already seen that, right? I mean, just think that it was November 2nd that the Fed raised rates to 400 basis points, 4.0%. And yet here we are 8 months down the line, 8.5 months down the line, and this economy is still producing multi-hundreds of thousands of jobs a month.
So real quick, average hourly earnings, that was the negative side. It was up. Well, it's not up. It's really sideways. It's moving side month on month, I guess, was up, but the year over year is pretty much sideways. And that's sort of, it's not nothing crazy though. These are average. This is just a reflection of a strong economy, That's what the reflection is. So with fiscal policy, right, even though there's 2 more rate hikes and everybody's like, oh my, it's going to crush the economy. I don't know. I don't think that's happening right now. And the reason why maybe these Fed guys are saying they can keep hiking and the economy will be okay, because they understand that the White House will keep spending.
So this is an economy that is stronger than people expect. And I think it can withstand, as I said, 1 to 2 more. But here's where I get worried is CPI is coming up next week. If that disappoints and it's hotter than expectations and we start talking about 50 basis point hikes, which, by the way, some people were talking about yesterday after that hot ADP report, then I think you got to start to worry about the regional banks again. I think you got to worry that this economy can't withstand that much. But 1 to 2 more rate hikes, yes. For me, it really depends on that CPI next.
Look at that CPI is not coming in hot. Oil's low. I mean, I could watch. I look stupid, but that's my guess. My guess is it doesn't come in hot. My guess is it comes in lower. And why is that? Because spending is falling. Retail sales are low, right? Services may be picking up a little bit, but retail sales are low. And overall, the base effects. This is the biggest base effects, right? The base of the highest inflation was in June of last year. So we're about to get, so we're about to get that June year over year print that's going to really push the momentum to the downside. And you can look forward and say, well, it's going to bounce from here. Sure. You can say that. That's why I'm keeping my eye on oil prices, because they might, fall off a cliff pretty soon. Maybe not. Either way, what point was I making here? Oh, yeah, I think this inflation is going to be low. I don't think it's going to be hot. How will higher rates affect regional banks more than it already has? Well, I think more than anything, the higher rates, because they're year over year. So the I would say this. I think that is a risk because the Fed funds rate is actually the lending rate for banks overnight. It's not really our rate. It's the lending rate for 24 hours. A 24-hour lending rate for banks. Dang it, AMD's taken off and I missed the entry. So what that means is it becomes more expensive for them to borrow. And at the same time, if treasury yields continue to climb on them, it means that their collateral is falling. So when you mix it all together, basically means they're at risk of collateral, but maybe they just keep pulling from the bank term funding program, right? They might actually be okay because the Fed created that facility to support regional banks. I think they just keep pulling from the bank term funding program. So it could be a non-event. It could be a non-event. But in the meantime, what do? We watch, we look at the KRE, right? Keep your eye on KRE. If it rolls over, there could be some uncertainty there. If it rolls over, keep your eye on the KRE until then. They keep looking at jobs added, but what about the people leaving the workforce, such as retirement? I guess a lot of immigration has happened. People are coming into the workforce, and yes, there is retirement happening. So I think really that keeps us neutral. Ron Veer, I think that keeps us neutral
next week.
Yeah, not only CPI, but PPI. Kevin, what did you think about what you heard from Austin Goolsbee and the fact that now we're seeing the 10-year back above 4%?
Yeah, well, I think it was a big shocker when we saw that headline number yesterday from ADP, but they tend to converge at times, and this week was a good example of it. But if you look at it year to date, ADP is 263,000 jobs per month, and BLS is 278,000 per month. So it puts things in a little bit better perspective, which I think may take that 50 basis point threat off the table. 25 basis points in July, absolutely still a go. Whether they do another 25 the following month or not, I think it's still a high possibility. But yesterday, I think it was a certainty.
Steve, what are you thinking? I mean, Jim pointed out something really important here. Hourly wages rose more than expected. A lot of people see that as a key metric, as an inflation proxy, if you will. Do you, in your mind, 2 more hikes definitely happen as Austin Goolsbee laid out? And does that also lead to a possible soft landing? Do we avoid recession? Or does that cause something else to break?
I think it'll be a mixed recession. I think clearly the people that live paycheck to paycheck and did before the pandemic, during the pandemic, and now they're disadvantaged because they're still seeing prices go up. Right. Granted, the pace of inflation has slowed, and you could see a number that's really sub-4, nicely sub-4 this time, but they're still hurting, and we see it in terms of some of the retailers, what they're reporting. On the other hand, you know, corporations still suffer from PTSD, which is shortage of labor. So they're not, aside from the big tech companies that laid off a lot, they're not really laying off. But 2 rate hikes, in my view, are a certainty because not only did you get wages increased, right? You've got labor participation rates staying flat. You have work week moving up. You want to see work week moving down as a precursor to lower numbers. And you're still above 200,000 jobs. Right. So that's not where the Fed wants you to see. The good news is that women participation rate is the highest it's ever been, besting last month's high. Where that's good for healthcare. Because a lot of women go into healthcare or services, so that may help give some relief to the healthcare sector, which has been killing them.
You know, to your point, healthcare, one of the areas seeing the biggest jump when it comes to hiring. Josh Brown, I want to come over to you, just bouncing off what Steve had to say.
Well, yeah, they have to leave OF. No, I'm just playing. But for sure, you know, the other risk too that's funny is the AI, right? The AI is they reported yesterday, AI is taking over most of the female jobs, like the clerk or the little calendar stuff, the knowledge worker. So that's interesting. But either way, like AI is still going to fill a lot of jobs. So I'm not too worried about going forward. Is there going to be a lack of labor supply? You're always going to get construction workers. They're not going to not show up because they need a job. It's these knowledge workers, I think, that the AI fixes in the long run. Dang, the S&P and the Qs are moving, by the way. I mean, they're not they are. They're moving. They're moving. Dow is moving. Everything is moving. The whole market is bidding higher at this point.
He talked about working class people being the most deeply impacted, you're one of the people that's really been flagging the kind of the bifurcation when it comes to the economy and consumer spending. So if working class people are hurt possibly by 2 more hikes, doesn't that hurt the overall economy and the markets?
So it's tricky because for every story I could tell you about working class people being hurt by higher borrowing rates, especially when it comes to things like auto loans or credit cards, I can then tell you the other side of the coin is wealthy people making more money than ever in their portfolios. We've just had the best first half of the S&P 500 since 2019, and people with big bond portfolios, whether we're talking about corporates, municipals, treasuries, money markets, are now getting a ton of income on their excess savings. And that is in part fueling some of the animal spirits that we continue to see in real estate, for example, vacations, et cetera. So it's really tough to point to one specific economic variable and say it's good, it's bad, it's bullish, it's bearish. There's always another side to the coin. I want to tell you that right now in the treasury market, there are no yields on the curve below 4%. The lowest yielding duration today is the 30-year, which is 4.02%. The highest is the 6-month, which is 5.5% yield. So that's what I'm talking about. There is, in fact, a wealth effect coming from the overall level of income that people are earning effectively risk-free in their accounts. The 1 year is now 18 basis points.
So basically, there's more money flow because all the people who already own bonds who are getting those yields, they're getting paid by the U.S. government. The U.S. government, if you own a treasury, you own the debt for the government. So they're going to pay you an interest rate for letting them borrow money, right? So rich people, it's not us. We're not going to own bonds because we want, you got at least $10 million to really, for it to be meaningful. And so as those people with tens of millions of dollars, hundreds of millions possibly into the treasury market, they're getting a yield and they're spending. So those retirees who own a bunch of treasuries, they're going to keep spending that risk-free yield, and very bullish for the market.
Higher than where it was just prior to the Silicon Valley Bank debacle in March. So that's back at its pre-SVB high for the cycle. Now you look at employment. U.S. employers added 209,000 jobs. Okay, that's great. It's the 30th consecutive month of gain in U.S. payrolls, but it's the first miss versus expectations in 15 months. So yes, the labor market is still incredibly strong, but it did not surprise to the upside this time. More importantly, the ISM services prices paid index was the lowest reading since March of 2020, which is in line with what Steve Weiss is saying and what Jim is saying.
Yo, have we not talked about that? We talked about that, the prices paid. Remember we said that all this wage inflation, supply side inflation. Well, the leading indicators for the economy, manufacturing, ISM PMIs, services PMIs, the prices paid are hitting low levels, which means that this is Goldilocks. New orders are climbing while the price is paid, or the cost to run business is low. Very bullish.
Saying so, we now have full employment. We now have a situation where the working class is, let's call it, somewhat less disadvantaged than they had been because wages are good. But we have prices around the economy moderating outside of airline tickets and hotel bookings. The slack that we need for this economy to function is back in a lot of ways. You can get a car now.
Right.
So like if you look at just the big picture of all the negatives, all the positives, I think it tilts positive, or at least positive enough for us to feel as though the second half can look a lot like the first half and not some sort of radically different environment.
Brendan, what do you think? You share that opinion? I mean, we just heard Austin Goolsbee, a lot of confidence. He seemed very confident, had a lot of conviction that we can see 2 more hikes without causing some type of recession. Do you share that opinion? Are you worried about the possibility of maybe?
No, that's super bullish for the market too. That the Fed is, remember, the Fed's expectations are important. So if the Fed's saying that, the market believes it. The Fed's not trying to trick the market. It's, if anything, it's going to say 2 more hikes, because if something does go wrong, guess what? More liquidity. Expect that Fed balance sheet to go up.
Maybe even a 50 basis point hike that Jim pointed out.
Well, I mean, I think Austin's great. I'm always
careful to parse my words, and like anything's a possibility, but what's the probability? So when you look back the last 30 years, the Fed just raising rates hasn't caused a recession. It's really been this event that has occurred. And so I think that you'd have to have an event occur because of these rate hikes, and that's not really predictable at this point. I think to hit on some of Josh's notes also is don't forget the baby boomers. They have all of the money, and those rates at 5%, I mean, Josh just walked through that. There's no yield under 4. You can get over 5 on the short end. That is meaningful in those baby boomers' pockets who don't need to take a lot of risk, and that does trickle down into the economy. I think we continue to have a summer rally, and really for 2 main reasons. I think the 2-year more than the 10-year is what you want to watch. We kissed 5%, and going back, the last time we hit that was right before SVB. I don't think the economic data is strong enough to keep the 2-year above 5% or around above 5% for any meaningful period of time. I do think that will start to trickle down.
I agree. It's not like the economy is accelerating. It is decelerating. Keep that in mind. The economy is still decelerating, so these yields won't keep climbing. They're anticipating maybe some risk to the upside. So they're decelerating, but still in expansion territory. Hey, that inflation report, I think, comes out very low. We get yields come down. We get another bid on the market. So by next Friday, we could be at all-time highs.
And then also, Frank, next week, CPI comes out. And you have to remember, this is a 12-month, month-over-month number. June of 2022 is the last month that we had a 1 handle. So in June of 2022, we had a 1.2% print. That is going to be the last month that's on there. And all of a sudden, by the July print, which comes out in August, we will have a 3.25% CPI. And so I think that these animal spirits will continue. My thought is looking out past that. I do think inflation will be sticky and will stay around that.
Yes, the animal spirits is what I call the wave 2 FOMO. It's coming, guys. It's coming. Wave 2 FOMO is coming, especially after this next. It's all coming down to the inflation report. Look at the labor market is strong, right? The economy is strong. Fiscal policy is strong. Monetary policy is supporting. When I say that, I mean FBTFP is supporting the banking system from falling apart. And that inflation report is going to come in pretty low next month. And that's going to cause the animal spirits to come out. That is the humans love FOMO, right? The 3 things humans love: sex, leverage, and food. So they're going to keep leveraging their accounts. And that's what's coming. And either way, point being that I'm going to accelerate this. There's nothing we haven't heard. I don't think there's any more surprises. Josh Brown is, let me see, what is Josh Brown talking about here? If there's anything new, I'm going to have it in the newsletter. Technicals, next move for the market. Oh, so they're going to talk about the next moves for the market. That's interesting.
So look, so
really badly, and trillions of dollars were transferred from people who didn't know better to people who did. And that was the story of 2022 and the value versus growth rotation and the comeback for energy companies and commodity companies, et cetera, et cetera. This environment, I think, while it's as boisterous a rally as any we've seen, 17% first half for the S&P 500 is a really great year, really great full year. We got it in half a year. Yes, but look at the companies that are benefiting in this route. Look at the stocks of the companies that are benefiting. This is what should be working. It's the companies that have demand, have improving fundamentals, have maybe not the lowest valuations ever, but certainly nothing like what we saw rallying in 2021. So even if you've been a little bit more on the cautious side, which I have been, even if you've been more on the hesitant, I'm hesitant to jump in and join the party, you're still making money this year because the right companies with good fundamentals are doing well. This is not through the looking glass market like what we saw 2 years ago. And I think you can take some solace in that, even if you think maybe it's too fast, even if you think maybe it's not broad enough. Like whatever your reservations are, at least understand the companies rallying happen to have business fundamentals that are improving.
All right, speaking of rallying right now, we want to look at the markets one more time. We're seeing the indexes at session highs right now. The Dow getting very close to.
All right, yeah, that might That might be the nail in the coffin. And we talked about that, right? How can they, oh, chips on the table, how can they keep running higher? Because they are the best companies in the market. They're pulling the most revenue, they're pulling the most growth. So I'm gonna close out here. Don't forget to subscribe to the newsletter, help support me and my channel, support the YouTube channel so we can get some more commentary on here. I appreciate you guys for sure. I'm not gonna close it out like that though. I'm gonna close it out with the kind of like looking over everything. So let's take a look at what we're seeing here. Let me pull up this chart. Let me pull up these charts because I want to make sure that we definitely get this going. Okay, so to finish off for Friday, right? What did we see this week for the macro? For one, the market is pulling back because the labor market report was very hot. Who cares? That's good, right? So it started to digest all that news. And what did we see? The market found support, moved higher. Same thing. We had another strong labor market report, right? The labor market, one of the pieces to the macroeconomics, which is the housing market, the consumer, right? And the consumer is bracing for a recession, by the way. The consumer is spending less, saving more, while their incomes are hovering at the same level, while their incomes are increasing in some areas. So the macros are lining up, right? The housing market starting to bottom. We're seeing that in builds and new builds and construction builds, and non-residential is also moving up because the government keeps spending in infrastructure. That's going up. CHIPS Act is still taking place, so things are starting to move up. When we look at the ISM, the leading manufacturing indicator, we saw that basically business activity is still in recession territory. The positive is it could be bottoming. It could be bottoming. And if it is bottoming, that is the last signal from my macro. How do I say this? When I look at the macro, the dollar needs to drop 101 to really get this market to all-time highs, and or to really just understand that the powder is gone, right? All that powder is going into the market, and you need the ISM to go up because that is the ISM survey, the PMI. Once that bottoms out and starts getting above 50, boom, it's over, and this is the new bull market. I think we're in a bull market, but some people say not till we get to all-time highs. Well, that will be the signal right there, or that will coincide with the all-time highs to some degree. So the ISM is doing well. Prices paid are down, so we're not seeing supply side inflation. That's positive for growth. That helps with the Fed's narrative that we want to get inflation down. Looking at the jobs report, unemployment is low. We already said that. People are coming into work. We know that's the labor force participation is tight. That's good. Average hourly earnings still kind of hot. Maybe that's why they hike. Maybe they keep hiking, right? Maybe the market will keep our eye on bond yields, the cost of capital, to see if it keeps climbing while the average hourly earnings stay steady where they're at. So we're going to keep our eye on that. There's just no big there's no big catalyst yet. If anything, the catalysts and the variables are definitely adding on to each other for a bull market. That's what we're looking at. The bull market is setting up, man. It is continuously setting up. We've been calling this for a while. The negative is global liquidity looks bad, right? The Fed's balance sheet is right back down, but is it really that bad when they're, funding the banks? And if KRE rolls over, if KRE does roll over, here comes more BTFP, buy the F and dip, or buy the Fed pivot, what they call it, BTFP, or Bank Term Funding Program, whatever. So everything is setting up. We got the services are expanding. Manufacturing might be in recession territory, but services are expanding. Services are moving higher. They bounced at the 50 level. They're back to 53. So people are paying for services. The service economy is 70% of the economy. That's good. That's strong. We're staying afloat there. And again, I'll get the details in the macro report. I put it in YouTube down there. Link in the bio if you're not already part of the macro newsletter. If you want to help me out, send it out to somebody else. It's free anyway. Right now, going to the rest of it. Yeah. In the last 3 months, consumers spent less than their incomes. They're spending less. They're bracing for recession. Consumers, so are you guys, probably bracing for recession. And that is a signal that even if things do start to downturn, the consumer is going to be okay. They're going to keep spending, right? Just not on goods. Construction spending is up. Non-residential construction is up. So building, like there's going to be enough jobs. There's going to be enough jobs. Retail sales decline. They continue to decline, but still in positive territory. So people are buying less goods, but their savings are going up. So that's positive. overall at the technical level, and keep this in mind too, GDP is beating expectations. As it declines, it's still beating expectations. I want to pound that in your head to understand that GDP might be bottoming. Maybe it's another quarter, but GDP is starting to pick back up. It's at 2% estimated, or it's projected to be at 2% this quarter. But we could see, it's estimated at 2% this quarter. We'll see how that plays itself out. Technically, like I said, the Qs, S&P 500, they all pulled back, but they are now starting to find that support. And we're looking at wave 2 FOMO. I think it comes in next week when we get the inflation report. The thing that's going to put, this is the most important thing right here. The thing that's going to get this wave 2 FOMO back online, and we already know the employment numbers are strong. We know that the economy is strong. It's going to be inflation decelerating, Goldilocks opportunity here, which is that CPI headline is dropping fast. The big base effect is June of last year, which means June of last year was the highest print. And if we measure year over year and inflation is decelerating, it's going to boost the actual difference. And I know that's kind of confusing, but the difference means we should get the biggest downside print next month, and that's going to cause more FOMO for a lot of fund managers who are just not in this rally, who are missing out on it. Retail investors who see, dang, inflation's making progress, FOMO, the animal spirits come in, and core inflation being a little sticky. I think that's going to resolve itself as shelter prices start to decelerate. We saw them talk about home prices earlier in Phoenix. In certain areas, home prices are decelerating pretty quick. Rents, blah blah blah. There's more supply of. We're getting more supply on the multifamily front. Okay. So that is happening and prices are falling regardless. So I think the shelter prices are going to filter through and we're going to get that deceleration in prices. Therefore, core CPI falls over. The other risk is oil, right? Does oil roll over? Does it stay? If it stays sideways, we're okay, along with the dollar. If it stays sideways, the market's going to keep bidding up. If the dollar goes up, if oil goes up, that's going to be a risk to the market. But if oil collapses because of the lack of demand for travel, the lack of demand for people going to work and meetings and business or whatever, then and really the virtual economy is what we're looking at here. Zoom, Zoom, Google Meets, all those virtual things, Discord, all the meetup, social stuff that's going to happen. You're going to have less demand for oil. That's why the OPEC is cutting production, because they see, oh shoot, oil demand is falling. But if Iran and Russia keep producing more oil, it's going to cause the Saudis to pump more. Maybe I'm wrong. I could be completely wrong on that. That's just my bet. My bet is that we get a flush to the downside at some point. And what leads that also is the manufacturing sector. The manufacturing sector is pointing to lower oil prices right now. Okay, that's going to be delayed. Eventually, oil will bounce. Okay, it'll bounce eventually. But I think we have one more downside slip. Maybe I'm wrong. Either way, if it does slip and we get the base effect and we get shelter coming in, inflation's going to 2%. And the Fed's now going to have to change their expectation to, okay, we are definitely pausing, and possibly, maybe we actually cut rates earlier than we thought, only because inflation is back down to or they could just say, no, we're just going to hold rates. We got to see it at 2% for 3 months in a row or something like that. They could do that. Either way, the equity market doesn't care because there's $5.5 trillion of cash on the sideline. There's a bunch of people short the S&P still. A lot of fund managers short the S&P. They're going to get squeezed if we move higher. And all these narratives are starting to move into the market. People are getting dividend income. They're getting bond income. The rich people, anyway, the wealthy are still getting income. They're still spending that income, which fuels the economy, right? Fuels the capital markets. Keep in mind, China, Japan are still stimulating global liquidity. So we might be in a catch-up trade where these global indexes, right? The global market indexes in China, Japan, well, China's still a little low, but Japan for sure, the German DAX, the Russian, not the Russian ruble. Actually, the Russian stock market is at a 52-week high, by the way. And then also the India stock market's up, right? So we might just be having a catch-up trade here where the S&P needs to catch back up to all-time highs. And I think we see all-time highs by the end of the year. So a lot of catalyst. So far, the jobs report just told us that the economy is strong. Going into next week, do we get a deceleration in inflation? Goldilocks scenario, right? Let me see. But yeah, demand destruction is really hitting. Yes, demand destruction will be hitting, which will lower those rates at some point and get more liquidity into the market. Because in a slowing environment, when the economy is slowing, that's where liquidity starts to come in. That's my thesis. Maybe I'm wrong. Either way, I'll be on tomorrow morning on YouTube. Maybe I'll throw up, I'll probably throw it on TikTok too. and we will go over the actual report with the actual data and comment if you want to, you know, if something's confusing, you can comment on that. Either way, I appreciate you guys on here. Wouldn't be nothing without you. Let me see. Leave early today. Got to hit the gym right now. Yeah, hit the gym. Make sure you guys get your mindset straight. Get straight. Can't even talk. Get your mindset. Keep. I know. Stupid. Keep your mindset. Keep your mindset strong. That is the name of the you know, the platform we have, Mind Growth, to grow your mind. Right. Fitness. If you guys want to diet, go jump on the fitness. Go jump to the website. I have a diet on there for you. Just go to fitness, workouts, all that. Well, we got to get more workouts on there. But either way, stay strong, stay blessed, and I will catch you tomorrow morning. If not, I'll catch you on the next market open. All right. But it was a good week. Is this thing gonna work? Keep it up. All right, yeah, keep it up. Anyways, we'll see you guys later. TikTok, YouTube. Thanks. We'll catch you tomorrow morning. And don't forget to subscribe to the newsletter.